We think that the opportunities are mostly in U.S. large cap stocks.
For longer term investors, the debate on NVIDIA is, are they selling razors or razor blades?
As good as this bull market is, any news that sort of disrupts the narrative can cause volatility.
Every time there is like increased pressure on NVIDIA, they can always, scale back and deliver.
NVIDIA is 20 times the size of some of these markets. So that's why it's so critical here to portfolios.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now as we come into Thursday on a 3-day run without losses on the S&P 500. Your scores look like this on the S&P right now. We're negative by 0.25% on the Nasdaq 100. We're down about a third. This stock right here, the only stock to watch this morning, NVIDIA. NVIDIA just a little bit softer, failing to beat, Lisa, some huge expectations.
Basically, the year-ahead forecast was higher than the average, but not as high as potentially some of the highest estimates. And therefore, you're seeing a nearly 3% decline. We're all crying for it because it's only up 195% now year to date. But there is this question of how high is the bar for a company that seems to be gaining market share and, frankly, transforming a lot of industries. The problem still is demand is outstripping their ability to supply. Their sales are doubling and quadrupling. People want more.
In many ways, this is the market. It's about 9% of the Nasdaq 100, around 7% of the S&P 500, which explains why equity futures are just a little bit softer so far this morning.
And Bloomberg Intelligence is coming out and saying the concern over the forecasts are likely to be short-lived because of everything Lisa just outlined. When you look at this company, they missed analyst estimates on a quarterly revenue once in the past 5 years, is continuously exceeded expectations. If you're looking for maybe something to be a little bit worried about, is it the fact that their customer base is so concentrated? Is it the fact that maybe they are going to deal with tariffs or maybe more export controls when it comes to China? But this is just really on the margins of this story.
Do you want some worries? Check out the bond market yesterday. Here we go. Lisa getting excited.
Thank you. Yeah, definitely.
Yesterday afternoon, it was very quiet, almost snoozy in the bond market, and then a 20-year auction happened. And it wasn't very good.
Yeah, just to put it this way, bespoke, put it this way. Simply put, demand was horrible. Everyone was coming out with this sort of drama. But here's the issue. It's a $16 billion of 20-year notes. The 20-year note has sort of been the bastard child of the entire bond market since it was reintroduced in 2020. This was the second largest underperformance when it comes to how much it sold off after it came out since the reintroduction in 2020. A real question here. Does this indicate waning potential for treasuries to be a haven at a time of great concern for inflation? Is this the hallmark of concerns of the bond vigilantes? Or is this a messy 20-year auction at a time where, frankly, people don't know where it fits in their portfolios?
So we're totally on the same page. The 20-year is a very unloved maturity. I wouldn't use your language. Unloved maturity, the 20-year. But what it did tell me yesterday, Lisa, is just how concerned people are about upcoming auctions, how sensitive they will be to other auctions in our future.
The fact that an unloved 20-year auction is one that captures the entire bond market attention at a time when other auctions have actually done pretty well. This, to me, still is front and center. As much as we have seen a recent bid into treasuries, the fact that it's fading, even on some of the geopolitical concerns that have come back to the fore overnight, there is a question here. Are they really going to be the ultimate check on this president's policies? And are they actually getting concerned? Or is it basically the same story all over again?
This is why Game of Thrones down in Palm Beach, Florida is so important. Will it be Walsh? Will it be Rowan? Will it be Besson? Will it be Haggerty? We still don't know.
We still don't know. The decision is in flux, and it went very late into the evening. Scott Besson having a meeting with President-elect Donald Trump last night after he met with Mark Rowan and Kevin Warsh, but still no decision. Nancy Cook and Saleha Mohsen leading the coverage this morning. This is the line that stands out to me. None of the remaining roster of candidates were seen as perfect, according to people familiar with the information. No one is seen as perfect. He's still in search of his perfect treasury pick.
We'll come back to that story a little bit later. In the bond market right now, yields softer by 2 basis points. The 10-year just south of 440. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth, saying tech earnings estimates look too high. Matt Bryson of Wedbush, as NVIDIA's outlook falls short of big expectations. And we'll speak to the former Google CEO, Eric Schmidt, later this hour on the future of AI. We begin this hour with stocks falling after NVIDIA delivered a disappointing fourth quarter revenue forecast. forecast. Cameron Dawson of NewEdge Wealth looking ahead to 2025, saying tech earnings estimates are too high. Bloomberg Intelligence shows consensus forecast for tech going from plus 14 this year to plus 27 next year, even with Nvidia going from 140 this year to 50 next year. We don't see the everything house in tech able to deliver that kind of growth. Cameron joins us now for more. Cameron, good morning.
Good morning.
Is the bar too high for 25?
I think the bar is too high for that re-acceleration in tech because we don't get it from the other big tech weights. You don't get an acceleration from Apple. You don't necessarily get a big one from Microsoft. You get a deceleration from Nvidia. So it means that the market is pricing and effectively the everything else in tech truly re-accelerating. We're not quite sure if you can get that. So if you look at the 272 numbers for 2025 earnings, you look at tech, you also have to look at healthcare, which is the other area where there's a big acceleration that's priced in. It's set to go from 3% to 20% next year. But remember, expectations were for 20% this year, and all we got was 3%.
Let's stay on tech. AI, Nvidia, doing really well this year. The rest of the semi space, not so good. How do you explain the difference between the two?
It truly is AI and everything else. If you look at the equal weight semiconductor index, it's actually down 3% this year, which tells you that there is still a malaise in the old industrial, auto, China, old manufacturing part of semiconductors. That does reflect this weak manufacturing environment where we've been in, where we've had this historically long stretch of a PMI sub 50. So the question is, we do think that PMIs will start to recover only because of better sentiment. We saw that post the election in 2016. Does that translate to better manufacturing activity on a global basis? Or do you get this offset from tariffs where you still see this malaise take hold and it truly stays this world where you only have AI demand and everything else is weak?
So basically, what you're talking about is the AI side of the story that's really powered this market. A lot of people have come on the show and said, they agree with you that probably expectations are too high for AI to keep leading, but that just gives everything else a chance to catch up. Those semis are going to actually have their turnaround day. You hear those types of words from the likes of Micron and Intel. Why do you think that's not the case, that the rest of the market will just play catch up, even as AI maybe doesn't grow quite as much as some people hope?
Hope does spring eternal. And we do know that if you look at these very cyclical semiconductor industries, we know that it's the most cyclical industry in the world, that you have been in this weaker environment for a couple of years. So the bar is lower for a recovery. But the big question still comes back to tariffs. Will you see companies still want to invest in big manufacturing plants that would support the demand for these semiconductors? If there's a question mark about where the tariffs will come from, where should they be? And so that's that offsetting factor. Yes, the demand has been weak, but does it remain weak because of tariff uncertainty?
So everyone who's come on the show since the election has basically said, are you bullish on the U.S. or are you really bullish on the U.S.? And then I saw your outlook for this upcoming year. And basically, you're casting a whole bunch of cold water on this. And you're basically saying that it's going to be choppy. Stop being so exciting. Either you get chop that could create some drawdowns, or you get a bubble, which will end badly. Why aren't you more excited?
Well, look, we're excited. We're still bullish on the U.S. and we're still fully invested. The point is, though, is that if you think about 6,400, 6,700, all of that glosses over the path you take to get there. And the path is going to be really important. We think it's going to be different than 23 and 24. 23 and 24 was broadly up and to the right. But what we see is that because you're going in with high valuations, high sentiment, high positioning, as well as stretched expectations for earnings growth, you have this big high bar to jump over, which just suggests to get used to more volatility. So what we're talking to clients about is to say that if that volatility comes, what will you do with it? The classic Walter Deemer line of, when it comes time to buy, you won't want to. So we're trying to get our minds in process of accepting this volatility, wanting to step into it versus running away from it. But certainly we think it's that wide choppy range, not necessarily low vol up and to the right.
Is it choppy because of underlying economics or because of policy?
Probably policy. And policy, of course, could drive and influence the underlying economics. We think that big sweeping tariff policy is certainly a dampener of growth. It raises the question around at supply chain disruptions, which could be inflationary. But those policy wildcards of, do we get tax reform, tax cuts or not? Do we get higher tariffs? All of these things are potential sources of volatility. And because you're trading at such high valuations today, there's not a lot of wiggle room to absorb absorb that higher uncertainty.
So tariffs for you definitely are a tail risk. A lot of individuals have come on and said that. But a tax cut and a big tax plan, that would be a boost. How do you think about the sequencing of all this?
Yeah, well, that's the thing that we think it could be inverse from the 2016 sequencing, where we got tax cuts first and then we got tariffs. And that's one of the reasons for the weaker market that we had in 2018. This time around, tariffs could happen first. And we still have a big question mark as to whether or not you even get that corporate tax cut, simply because you are negotiating $4.7 trillion of existing taxes with a very slim majority in the House. A big question mark if you can get us down to 18% on the corporate tax rate, given everything else you're negotiating.
Let's finish on Bitcoin. Just took out 98K, all-time high. Multiple choice. A risk asset on steroids, an important diversifier for portfolios, or a proxy to play some huge momentum societal shift over the next few years. Which one is it?
D, A, and B. Meaning that we think it is definitely a liquidity proxy. This is a proxy for how much liquidity is sloshing around in the market. We certainly have seen that play out in other cycles, that when the Fed is removing liquidity, Bitcoin is typically done poorly. This is a world that, given the Fed is cutting rates with financial conditions so easy, that is supportive of this kind of asset. We think it is also a psychological commodity that captures fears about dollar debasement, the fact that you have high fiscal spending, the fact that you're talking about even more monetary spend or stimulus, which just supports this notion that there are people who are afraid of dollar debasement, and thus this is their way of being able to get access to that risk.
So Lisa would like to know some form of inverse correlation between the performance of a 20-year auction and Bitcoin. Is that right?
All I can say is a psychological commodity. Tulips were a psychological commodity. You could say pretty much anything. Or
oh,
how
you're
about
going to get so much love mail this morning.
Or I'm not just saying that crypto is tulips, but I will just say that a crypto platform founder of Tron, Justin Sun, bought a banana that was duct taped to a wall for $6 million yesterday.
I saw that headline.
So I'm just looking at this and I'm like, is that psychological kind of commodity, sort of to ease your fears?
I think that is the bubble scenario into 25, is that we get a spark of speculative fervor. And that is the scenario where you could see runaway markets because people start YOLOing on bananas taped to walls. And that could be something that would make its way into broader equity markets, where you see valuations push up into even more rarefied air.
You don't sound like a crypto purist at all. I remember these conversations years ago when we were trading down near 10K. Same conversations, and here we are up by 100.
Totally. I think that anyone who's been bearish on crypto has been humbled massively. And there's a lot of questions around exactly the idea of blockchain and how it could be used in supply chains and across a whole host of different asset classes. So there is a lot of value here.
That's a good cleanup effort, that one right there. Bitcoin right now, 98K, all-time highs, up this morning by around about 4%. Cameron, thank you.
Thank you.
Good to see you. Thank you. Cameron Dawson of NewEdge Wealth. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. U.S. prosecutors have charged Indian billionaire Gautam Adani with helping drive a massive bribery scheme. The charges allege that Adani and other defendants promised to pay more than $250 million in bribes to Indian government officials in order to win solar energy contracts, and then concealed the plan in order to raise money from U.S. investors. It's a stunning blow to one of the world's richest people and India's most powerful businessman. Volkswagen is bracing for an employee walkout. Company leadership and union members are still at odds over how to restructure Europe's largest car maker. VW, for its part, is seeking much bigger reductions that it insists are needed to slash excess capacity, including selling 2 car plants in order to cut costs. Talks will continue today, with warning strikes expected to start in December. Sources tell us that Starbucks is exploring options for its Chinese operations, even the possibility of selling a stake in the business. It's been speaking to advisors about ways to grow its operations in China. That includes the potential introduction of a local partner. Starbucks is still evaluating its options and hasn't made a decision about whether to proceed. That's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, NVIDIA's tall order.
I actually think that the results are great, right? And what happens is you have these lofty expectations, and so it's hard to beat lofty expectations. It's literally their game right now. And of course, people will catch up eventually, but I think that they're too far away.
That conversation is up next, live from New York City this morning. Good morning. Equity futures right now on the S&P 500 negative by almost 0.1%, recovering slowly. In the bond market, yields are down by, let's call it 2 basis points. The 10-year 4.39. Under surveillance this morning, Nvidia's tall order.
I actually think that the results are great, right? And what happens is you have these lofty expectations, and so it's hard to beat lofty expectations. But they did give you that, extra 2% in either direction, and they're within the range of the outlook for Q4. They're the number one supplier of chips to hyperscalers, to quantum computing, to supercomputing, to data centers. I mean, it's literally their game right now. And of course, people will catch up eventually, but I think that they're too far away.
So here's the latest this morning. Nvidia shares inching lower following the company's blockbuster earnings report. The AI giant sales forecast falling just a little bit short of the highest estimates, despite reporting strong demand for its Blackwell chip. Matt Bryson of Wedbush writing, given the quarter's strength with management's commentary also seemingly addressing any minor investor concerns, we see no reason to shift our positive outlook on the stock. Matt joins us now for more. Matt, good morning to you, sir. Thanks for making some time for us this morning. What did you learn yesterday afternoon?
I think we learned that NVIDIA is still executing amazingly well. Look, they beat numbers again. Kind of consistently, they've been beating by 2 billion. They did better than that. They gave a guide that maybe was a bit light of the most optimistic forecasts out there. But when they give that guide, again, they've been beating consistently by over $2 billion. So, are they really guiding for 37.5? Or are they really guiding for closer to 40? And I don't think anyone would be disappointed with the latter.
Matt, it's pretty clear they don't have a demand problem. There's been some questions about supply over the last few quarters. Where are we now? Did you get enough clarity yesterday afternoon?
Yeah, so I think in terms of Hopper, which is their current chip, that all supply issues have been resolved, and that there is plenty of availability of Hopper. In terms of ramping Blackwell, you could call it a supply problem in the sense that they've said they're going to be short product for the next couple quarters. But I think it's rather a demand problem where they're ramping as quickly as they can, and they just can't meet the amount of demand from the large customers out there for that new Blackwell chip.
Anne-Marie mentioned this earlier in the show, and this really is a main concern for a lot of people, that the concentration among the hyperscalers is increasing. You saw the share accounted for by the customers, including Microsoft, AWS of Amazon, as well as some of the other cloud providers, accounting for now 50% of the overall sales versus 45% rather from the prior period. Does that concern you?
It doesn't concern me in the sense that if you look at total IT spend out there, the cloud providers are becoming a larger and larger portion of total IT spend. Also, when you think about these large language models that are being trained, I tend to believe that at the end of the day that maybe there's 3, 4, 5 large models that end up dominating. And so again, those customers are going to be those model builders are going to be your largest customers if you're NVIDIA. And so it makes sense to me that there's going to be some concentration. So I mean, it's only a concern in the sense that if you lose a customer, that's a problem. But I think it's the nature of the market versus there being specific risks to NVIDIA.
So what is your main concern, Matt, at this point? Because people are looking for concerns, basically. They're looking for a reason to consolidate some of their gains after almost the shares doubling in terms of valuation. You see incredible gains when it comes to just sales in general. Is there something that does create a concern for you that maybe they are reaching the limit, or do you just basically think that they're sandbagging the market once again?
I think that they're guiding the same way they've guided, so that they're leaving themselves a fair amount of cushion and setting themselves up to beat expectations. I think from a concern standpoint, it's not so much about this quarter, next quarter, the quarter after that. I think we're going to see those large customers take lots of Blackwell chips. That's going to allow them to grow revenue. They gave us a path to better margins. I think if there's a concern, it's end of 2025, 2026. So we're still waiting for a wave of applications based on generative AI to show up. And at some point, you need those applications to show up. You need generative AI to start creating a lot of revenue to justify all this CapEx. And so I think the concern is really if those applications don't show up, then do we get this worry that at some point spending doesn't continue? But that's not this quarter, that's not next quarter, that's not 2025. It's really heading into next year.
Matt, do you have any sense about tariffs potentially with the incoming administration and how that could constrain NVIDIA's China business?
So I think from a tariff perspective, NVIDIA has no choice but to use Taiwan Semi. So if there's a tariff that is slapped onto everything, they're going to end up most likely something's going to be tariffed. It might be the NVIDIA chip. It might be the server the NVIDIA chip gets built into over in Asia and is imported to the U.S. I don't see that NVIDIA has a way around that. In terms of their China business, I think it depends on how the new administration thinks about these kind of processors that NVIDIA is shipping there. They've already restricted the amount of technology that NVIDIA can ship. Potentially things get harsher. NVIDIA, I think, told us China was around 20% of revenues, if I remember correctly. Some of that would be at risk. Some of that, though, is gaming. So it's not all data center. It wouldn't all be at risk. But that's kind of how I'm thinking about things.
Well, what about the idea of like any disruption to the supply chain that it's using, so mostly in Taiwan?
Yeah, I don't think that there's a substantial risk of disruption to the supply chain, right? So if NVIDIA's supply chain was disrupted in the sense that TSM couldn't produce, it's not an NVIDIA problem. It's a worldwide problem. Because at the same time now, Apple can't make a phone. You can't buy an AMD processor. So 30 some odd % of servers, similar amount of PCs aren't getting shipped. TSM produces a lot of silicon going into automobiles, the end consumer devices. So this is a problem for the world. I don't think it's an NVIDIA problem.
Hey, Matt, appreciate your time, sir. Thank you. Matt Bryson there of Wedbush. On the latest, following NVIDIA earnings, that stock recovering just a touch. We're down by a little more than 2%. Broader equity markets recovering as well. Some earnings already this hour. They come from Dia. It's a tug of war, a little bit of tension between a really big beat for earnings and a very tepid forecast looking out, Lisa, to 2025.
And it's the why that's really interesting. You can see shares are doing okay, and Dia's trying to recover after a trough following some of the boom during the pandemic and the media aftermath. But this, to me, I thought was fascinating. A real question mark with Deere around what tariffs on goods that Deere makes. Remember, this is the biggest farm manufacturing goods product. Any products that they make in Mexico would be tariffed before coming into the U.S. And that's part of the reason why they had a more tepid forecast, with the CEO saying, amid significant market challenges this year, we proactively adjusted our business operations to better align with the current environment. This, to me, is what we should be looking for in a lot of earnings. What type of telegraphing about what kind of scenario analysis CFOs are doing around tariffs?
Well, we know a little bit because in September, President-elect Donald Trump, when he was campaigning, told us how he felt about Deere and basically said if the company does not abandon its move and idea of putting some production from the Midwest to Mexico, the walls were going up. This is why USMCA, trade between Mexico and Canada, is going to be so interesting and how he deals with that on day one.
It's going to be interesting to see how the tariff story plays out more broadly for this company, for farmer sentiment, not just for where they produce the tractors if they go down to Mexico, for sentiment for the farmers as well, given how much volatility we saw off the back of that trade war with China last time around.
The fact that they're not necessarily investing as much, is it because there is this concern? At a certain point, how do you plan for planting crops if you aren't sure what kind of demands or walls are going to be up in terms of exports? And that, I think, is the reason why the Deeres of this world are very important to watch.
Deere right now in early trading positive by 1.2%. Up next on this program, we'll catch up with Aditya Bhave of Bank of America after they slashed their expectations for Fed rate cuts heading into next year. From New York City this morning, good morning to you all. This is Bloomberg. In a commercial break, equities very briefly turning positive, just about unchanged on the S&P 500 now. On the Nasdaq 100, only down 0.1%. With NVIDIA yesterday after the close, dropping numbers and dropping initially by something like 4 or 5%. And we've recovered since then.
Yeah, basically people looking at the numbers and realizing, okay, they've doubled their revenues. Okay, they really are still beating across the board, and they probably are lowballing estimates going forward. So how much can we really dampen enthusiasm for this company? There has to be a big sea change in this company before you start to see some of the hopes truly dampened, given the fact they've still beaten every single earnings period except for one over the past couple of years. So, still pretty good.
Stock is down about 2.2%. It's up this year by something like 200.
Yeah.
So it's doing okay. It's doing better than okay. Let's turn to the bond market. Switch up the board, turn a page and get to this bond market story. The 20-year issue yesterday. We had an auction from an unloved maturity. Lisa calling it something else. I'm far more polite.
Oh,
yeah. Go there. Yeah. That's me. That's
acme
me.
of politeness.
It's a very weak auction yesterday, which triggered a sell-off in bonds, pushing your tire.
Yeah, basically people coming out and saying it was horrible demand. Just to put this into some numbers, the auction tailed by about 3 basis points, meaning that after it was sold, the yield was about 3 basis points higher than when it was before it sold. If your eyes are glazing over, basically this is really terrible. This is the second worst since this was reintroduced in 2020. And a question here about whether this indicates a broader tempering of some of the enthusiasm we saw for a hot second for bonds, or if this is just an unloved maturity with some choppiness.
Some of these issues breathing some life back into the US dollar, the euro weaker, 105.27. Also, in some way, contributing to this move. Bitcoin, all-time highs, up by 3.7% early this morning.
Wait, do you actually think that the auction had anything to do with Bitcoin being up almost 4%?
Deficit concerns and the debasement of the dollar are a factor in some people's long view of Bitcoin.
I mean, I guess that it's hard for me to really understand exactly what is driving Bitcoin, considering that we might get a crypto czar from President-elect Donald Trump. So that also could be generating some enthusiasm, this idea that we're going to make crypto great again in the nation. There is also this bigger sort of gut check that when there were geopolitical concerns, bonds were bid, gold was bid, Bitcoin was not. So even when there is some sort of geopolitical hiccup, we're not necessarily seeing an obvious reaction in crypto. It's more confusing. It's a psychological commodity safe haven that we were just talking about.
We do know that Trump talked to the Coinbase CEO, Brian Armstrong, and I'm just sitting here wondering, do we get a crypto czar in the West Wing before we get an announcement of the Treasury Secretary? And maybe that's why Bitcoin is getting a little bit of love.
I'd love to know what their policies would be. Bitcoin crossing 98K for the first time ever. A little bit early this morning. Under surveillance this morning, Nvidia's outlook falling short of big expectations. The chip maker predicting fourth quarter sales of about 37.5 billion, with analyst estimates ranging as high as 41. The CEO, Jensen Huang, saying the company's Blackwell chips are on track to ship this quarter. Lisa, that stock down by 2.2%.
So its sales are poised to double for the second year in a row. It now notches more money and profit than it used to generate in total revenue. You're talking about a company that keeps quadrupling and quintupling its earnings every single year and dwarfs the market share of all of its competitors combined. When you start talking about maybe have they reached the limits to their exponential growth just simply by virtue of how big they've gotten, okay, you can have that conversation, but it's not exactly going to rip the rug out from under this name.
Two potential issues is just the concentration of its customers and maybe down the pipeline what's going to happen with supply chains, with tariffs, with an incoming administration. But Dan Ives yesterday, after it came out, said, print the press release, put it in the Louvre. It is going to be green. The AI revolution is just beginning. And he gave his whole, it's 9:30 p.m. at a party that ends at 4 a.m. in the morning.
Doesn't he say that every quarter?
Sometimes it's 5 a.m.
You know, sometimes it's 5 a.m. OK, I love Dan, but I basically hear that every quarter. It's working. Can't argue with it. The stock is down by 2% this morning. It's up big time through 2024. Let's turn to this story. Ukraine saying Russia launched an intercontinental ballistic missile in a central Ukrainian city. The strike appears to be the first reported use of an ICBM since Russia invaded Ukraine, marking another escalation in the war through this week.
This is a serious escalation, and I think what we can expect is there's going to be tit-for-tat escalations given the fact that we have an outgoing lame duck president that gave Ukraine this ability to strike into Russian territory. And then we have President-elect Trump saying he wants to end this. So if you know that there's an end point from the American president that wants to end this war, you're going to do whatever you can to get into yourself into a better negotiating stance. I will say as well, the U.S. Embassy yesterday said that they received specific information. They were expecting a potential air attack and was telling all U.S. citizens in Ukraine. When you hear those sirens, because I've been there, sometimes you hear those sirens and people are so used to it, they shrug it off. They said, when you hear those sirens, you have to go to a bomb shelter.
What strikes me is that markets are basically considering this the escalation before the de-escalation. What would change that? And that's my key question, because we're talking about some pretty significant moves that would be considered escalations in a prior iteration of this conflict.
Couldn't agree more. And we've seen a series of them over this week alone. Let's get to this story. President-elect Donald Trump's search for a Treasury Secretary continues, with Apollo's CEO, Mark Rowan, among the contenders for the role. If selected, Rowan's exit would put a non-founder in charge of Apollo for the first time in its 34-year history.
Yeah, that's actually a really key question, considering how much he's grown Apollo. There's a bigger issue of whether he actually makes the market for private assets that much more attractive at a time where there seems to be a battle between banks looking for fewer regulations so they can compete with them, and then the private investment market looking for some sort of further establishment in the financial system. Nonetheless, a real key question for a lot of these potential nominees: how do they divest of assets that they have with their firms?
He is one of the best operators in financial markets anywhere on the planet.
100%.
If he gets this job, it would be a phenomenal pick. There are other really strong candidates as well, and I think I repeated this several times yesterday. Any of the four would be a tremendous, I think, for the United States of America. For Apollo alone, though, we've got two co-presidents kind of ready to go. Scott Kleinman, Jim Zelter, two people we know well on this program, ready to take the helm if they need to.
Right, so if he slots in, they will have a succession plan all ready to go in place. For Mark Rowan specifically, this would be a huge tax incentives, because you have to sell, but he can, defer the tax payments on that. Interesting, when I heard his name being floated around the Trump circles, I went back to a sit-down he gave at the Economic Club of D.C. with David Rubenstein. And when he was asked, if you were ever tapped and asked to go serve your country in any capacity, Treasury, the Fed, would you go? No hesitation, a resounding yes.
Watch this space. Let's turn to the Federal Reserve. Investors bracing for a busy day at Fed speak. The team over at Bank of America revising their outlook for the Fed, writing, "We still look for another 25 basis point cut in December. We then expect the Fed to slow down to a quarterly pace of cuts based on the data flow alone. For next year, we forecast two more 25 basis point cuts in March and June." Aditya Bhave of Bank of America joins us now for more. Aditya, it's good to see you.
Thanks for having me.
What's behind this change? And help us understand the mix between better than expected data over the last few months and anticipating policy changes over the next year.
Right, so let's just start with the data. We've been really impressed by productivity growth in the US over the last several quarters. Starting from before the pandemic, we're now growing at 1.9%, almost 2% in just productivity. Right? And that's significantly above where we were before the pandemic. So acceleration relative to the previous cycle and significant divergence from the rest of G10 for the record, right? Most other countries have actually slowed down on productivity. So that's very impressive. It's a combination of new business formations, CapEx, hybrid work, really working in certain job functions. So you put all of that together, that means higher potential growth, and then obviously higher terminal rates as well. On the side, inflation's also been a little bit sticky. That's another reason why the Fed probably wants to slow down. You heard that from Fed Chair Powell last week. So just based on all of that information, they probably sneak in a cut in December, although even that's gotten to be a close call now. And then we think they slow down to a quarterly pace. After that, you get to the risks around potential tariffs. Huge uncertainty here. We have to pick some base case, but things are going to evolve quickly after January. So based on the tariffs, we think if as much as has been sort of threatened is actually announced, then you could get them pausing by June.
So is this basically what you're reading into the Fed speak that we've been hearing? A hesitance in terms of cutting too quickly because there is this feeling the neutral rate is higher, the economy has been doing better than they previously thought, and there's this policy risk that they don't want to talk about, they don't want to say that they consider, but they absolutely do consider and could potentially be inflationary?
They could be considering the policy risk. It's hard to say because, as you said, they just don't want to talk about that, and that's very reasonable. But just based on the data, they can say for now that we're going to slow down, and then we'll figure things out as the policy priorities become clearer.
So is your base case now that they're going to skip next month and that basically they're going to take a look at whether the risk of reinflating inflation is once again very much on the table?
So our base case is that they do cut in December, but after that they skip. So they skip January, right? We have cuts in December, March, and June. And December is admittedly a very close call. It's going to depend on the jobs data. It's going to depend on CPI and PPI, which we get before the December meeting, but for now we think they sneak in that December cut. Markets are priced around 60-40, which seems fair to us for now.
So there's a larger question here, and we've been asking on the show for a number of weeks, which is there a signal from the fact that the long end of the yield curve, that longer term bonds, that yields have gone up so much since the Fed cut rates by 50 basis points and then again? Do you think that they have to reference that essentially there's been a real tightening of financial conditions at the places where a lot of the consumers who got hurt by it feel it the most, like mortgage rates?
Yeah, we thought the 50 basis point cut was a mistake, to be honest. We didn't think it was necessary. Obviously, that's easier to say with the benefit of hindsight, but markets are now saying we're concerned about inflation, we're concerned about a higher terminal rate, and that means long-end yields move up, right? And markets are also concerned about issuance because of the potential for more fiscal stimulus.
If the Trump administration moves very quickly with tariffs, do you think there's a chance that we see no hikes next year? No cuts?
No cuts. Everything's on the table, to be honest. So one of the things that we said in our report is that our base case is sanguine, but our conviction is low. So I think really everything is on the table, and we're only going to learn more as we kind of get a better sense of where policy is going.
Do you think you have a grasp at all on what the sequencing could look like in terms of tariffs and tax cuts?
There's many ways to think about this. One would be that tariffs are easier to do quickly because they can be done mostly via executive action. Another is that they might want to, time them sort of simultaneously just so that any potential downside from tariffs is offset by upside from potential tax cuts. So there's a few different ways of thinking about it.
I still don't think we appreciate how quickly they're going to move in the next 12 months. They could move really quickly in the first few months.
Absolutely, because when it comes to things like tariffs, it's that unilateral executive order that President-elect Donald Trump could rely on in January. And they've been doing the work leading up to this potential win. Maybe not him and his very close team right now, but other individuals who had worked in the Trump 1.0 that were thinking about, I might go back in.
You get the impression they might be ready to hit the ground running. Aditya, it's good to see you. Thank you, sir. On the outlook for 2025, Aditya Bhave there of Bank of America with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Archegos Capital Management founder Bill Hwang has been sentenced to 18 years in prison for fraud and market manipulation. This summer, a New York federal jury found the 60-year-old guilty of manipulating stock prices and defrauding banks. The Archegos meltdown in the spring of 2021 led to the downfall of Credit Suisse, caused significant losses at Morgan Stanley and UBS. The Justice Department and a group of states have proposed major changes to Alphabet's Google, including a forced sale of the company's Chrome web browser, confirming Bloomberg's earlier reporting. In a proposal filed late Wednesday, the DOJ argued that a sale would free the search market from Google's grip, while also seeking to impose restrictions on its AI models. Google said the proposals would harm Americans' privacy and security and hinder Google's investments in AI. Donald Trump's transition team is holding discussions on whether to create a new White House role dedicated to cryptocurrency policy. Sources say Trump's team is vetting potential candidates for the role, with crypto executives visiting Mar-a-Lago in recent days, where the president-elect's team is holding personnel discussions and interviewing prospective candidates. Sources say that crypto industry advocates are pushing for the role to have a direct line to Trump. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Bitcoin this morning briefly through 98K. Up next on the program, the rise of AI.
The real fight now is AI.
Winning the AI battle for the United States is paramount from a military and an economic perspective.
This is potentially an industrial revolution for America.
Next on the program, we'll catch up with the former Google CEO, Eric Schmidt. From New York, this is Bloomberg. Live from New York City, welcome to the program. Here's a snapshot of the price action for you. Equity futures on the S&P up by close to 0.1%, turning positive. And Nvidia was down by 4 or 5 percentage points after the close yesterday, recovering through this morning. In the bond market, yields down by close to a basis point, the 10-year 440. Under surveillance this morning, the rise of AI.
The real fight now is AI.
Winning the AI battle for the United States is paramount from a military and an economic perspective.
This is potentially an industrial revolution for America, where the artificial intelligence infrastructure, which is wildly insufficient for AI adoption, that could come very quickly.
Whether it's chips, technology, AI, and there's going to be very little to no grounds for kind of movement with China. We are going to be at an economic kind of Cold War with China.
So here's the latest this morning. Leaders in artificial intelligence preparing for a second Trump administration. The build-out in AI, fueling competition for chips, energy, and raising tensions with China. The former Google CEO, Eric Schmidt, joined us on his latest book, Genesis, Artificial Intelligence, Hope, and the Human Spirit. Eric joins us now for more. Eric, welcome to the program, sir. I want to pick up on that one word, hope, and ask you how much hope I should have that this goes right. And start with this quote from Foreign Affairs magazine. It reads as follows. In cases where some humans might face off militarily or diplomatically against a highly AI-enabled state or against AI itself, humans could struggle to survive, much less compete. Such an intermediate order could witness an internal implosion of societies and an uncontrollable explosion of external conflicts. So you've got to calm me down, Eric. Should I have hope that this plays out well?
Well, let's start with a hope that by the way, your show is incredible. Previous guests talked about 2% productivity. Imagine that productivity goes to 5% a year because of this technology. So there's every reason to think that there's enormous land, businesses, inventions, science, health, and so forth that get invented. But the same is also true for the invention of conflict and war. And if you think about it, it makes absolutely no sense to put somebody in a fighter jet up in the air and have them be shot at by another missile. It makes much more sense for that fighter pilot to be sitting on the ground and having a swarm of the equivalent of those jets, let's just call them powerful robots, powerful drones, that act in synchrony to achieve the objective of this attacker or to defend yourself. And the future of war is autonomous and networked and AI-driven.
This is something that a lot of people have focused on, in particular, how the U.S. is going to evolve in this manner, as well as how China is going to evolve in this manner, how they're going to use some of the space satellites to help coordinate that effort. Eric, do you feel like right now one superpower is winning versus the other? What is the best way to gain preeminence in a military AI sphere?
Well, when Dr. Kissinger and I went on his last trip to China, I was convinced from that meeting that China was 2 to 2.5 years behind us, but I am now wrong. Turns out that in the last couple of weeks, China has brought out software models, what are called large language models, that are rivals of the best American ones, which I never thought would be possible. One is called Qwen, another one's called Hongyang, and it looks like they've caught up, or they're very close behind. And it looks like China has decided that it's another part of its industrial policy, along with its focus on cellular, dominating the battery industry, dominating the car industry, et cetera. So they're willing to spend the money. What's interesting is that it does frame the narrative of China versus the U.S. as the defining narrative. And one of the more interesting questions, which we discuss at some length in the book, is what happens to deterrence and what happens to all the other 195 countries that are not China and not the U.S. These questions are really important because the power of this technology upends society in so many ways, economically, the way we govern, the way we reach, language, and so forth and so on.
So there are a lot of questions within this, and this could be a half-an-hour discussion. But one of them is who should be financing and who should be leading the national efforts to gain preeminence in this sphere. And you have to wonder, you talk about China as a state-organized, state-funded type of effort that is coordinated in that manner. How should it be directed in a place that does consider itself capitalist, like the United States?
Well, the Chinese model is what is called civil-military fusion, where they subsidize their biggest companies. No one in America, not even in the companies, thinks that the largest American companies need to be subsidized. But let me make an argument that if general intelligence, that is human intelligence, is to be invented, it should be invented in the United States and under control of Americans and the American government. And I don't mean managed, but I mean under the legal control of our country and our citizens and our democracy. And getting there first is a big deal. A number of us have talked for some time that there should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time. In truth, however, the financial industry that you all invented, for which we are incredibly grateful, has been incredibly generous in terms of the ability to fundraise the billions of dollars that are required. And I should state, by the way, that you guys have done such a good job in raising money, and we've done such a good job in actually getting the computer scientists around the world and the data and so forth and so on. What we now need is energy. We are prolific consumers of energy, and we're going to run out. One estimate is that the U.S. will run out of all sources of energy by 2028 at our current growth rate.
There's another topic you discussed in this book, which is AI to check AI. How can that work?
If you think about it, one of the things that happens is in AI systems is you have compositional generations. What happens is you take one piece and another piece and you interlink them, and they've never been linked together before. And it looks like when you combine those two, you get emergent properties, right? So that's in and of itself interesting. So the question is, what is the limit of that? How far can that system go up? I think it will get there. And I think that it's probable that we can build systems that are, the technical term is super intelligent, where you have a single system that is at the 90th percentile of physics, math, chemistry, and arts, and so forth. No human can do that. It looks like these systems will be not only available in the next 5 years, because we already have examples of passing these tests already, but also that they'll be broadly available for all of society. That has huge implications. We've never had an experiment where each and every one of us has a polymath, the Einstein-type scientist at our beck and call. And furthermore, that scientist, whatever you want to call him or her or it, is capable of writing code, doing agents, and making things happen.
How do you think the United States competes with China when we have an incoming administration that wants to put up tariff walls, and even this administration who's been putting export controls on some of our high-tech semiconductors?
I am not in favor of broad tariffs. I never have been. I'm the son of an economist and a grandson of an economist. And tariffs are essentially taxes. What I am in favor of is restrictions or limitations for strategic reasons. It's really important that we win in this race against China. And so the things that the Trump administration and Biden administration to limit, for example, hardware access were really smart. And I know because I was part of a commission that recommended it way back when. And it in fact was adopted. Great job. So the question here is, ignoring the tariff question, which I just don't like, and I think is just another tax, how do you control and limit what China does, and how do you amplify what America does? And you sit there and you go, well, you're doing pretty well, right? Everybody's making a lot of money. There's all this growth. NVIDIA is doing well. All the tech companies are doing well. But let me explain what happens. You have a slope that's like this, and it keeps going up and up and up with humans. At some point, the industry believes that there will be AI scientists, that is non-human scientists, and he or she who gets there first gets a slope like this, and all of a sudden, boom, right? We're really, really growing fast. These network effect businesses are what we do in our competitive environment against each other under U.S. regulation. I want that to be true globally for the U.S.
Eric, I can tell you we're all in favour of having you back soon to continue the conversation. Congratulations on the new book, sir. We appreciate your time. The former Google CEO, Eric Schmidt. Up next on the programme, coming up, Gargi Chaudhuri of BlackRock, Monica Guerra of Morgan Stanley, Jason Draho of UBS, and we'll catch up with Samantha Dart of Goldman Sachs. The second hour of Bloomberg Surveillance, just around the corner.
There has to be a real rethinking by the new administration of how do you want to interact with the world.
Tariffs are probably going to hit both consumers and corporations.
The mandate is to move fast, and that means more volatility.
The folks that argue that tariffs are just absolutely negative and inflation causing, they're playing checkers.
The math is very clearly easy. Politics and implementation is what is difficult for 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I don't know about you, but over the last few weeks, struggling to keep track of what day it is. It is Thursday. From New York, the second hour of Bloomberg Surveillance starts right now. It's been a blur since the election. Equities right now on the S&P 500 just about positive, on the Nasdaq 100 down by only 0.1%. The focus on one stock, of course, this morning. After the closing bell yesterday, Nvidia came out with earnings. The forecast, can we use the word tepid? I mean, maybe just a little bit relative to the biggest expectations out there. As the session grows older, this stock recovers even more. Lisa, we're down by 1.7% in early trading.
Let's put some numbers on tepid. The tepid forecast was for fourth quarter sales of about $37.5 billion. That was tepid compared to the average analyst estimate of $37.1 billion. Oh, wait a second. It was more than that, but it wasn't the $41 billion that was at the highest end of those estimates. And I guess people are trying to figure out, can we start making these grand assumptions that they're at the end of their expansionary phase, or are we being a little bit picky and maybe just a little bit having indigestion after a 200% gain so far this year?
Then the attention starts to turn to the data. In about 88 minutes' time, we get jobless claims in America. The estimate in our survey, pretty decent, robust stuff, 220. 220 is the estimate in our survey. 217 was the previous read. We heard from Aditya Bhave of Bank of America about 20 minutes ago. He made the point that he's expecting fewer rate cuts in 2025 than he had previously anticipated because the data was better than expected. It wasn't about the outlook and policy changes. It was because the data over the last few months has surprised to the upside.
That's exactly where I was going to go. Aditya Bhave, I think, put a bow on this very well, that essentially there's already been a transformation in markets before Trump won, and you saw that in the yield curve. You saw that with yields picking up. He said that it was probably a mistake for the Fed to cut by 50 basis points. Whether you can attribute it to that or not, the economic surprise index has been inflected higher to the highest levels since around April. As you see, better than expected jobs, better than expected production, as well as this idea that maybe inflation's a little bit stickier than people thought.
I think we're all hoping, though, that we can get some clarity on the individuals in charge of the policy. So let's go through the names. You know them well by this point. Bessent, Walsh, Rowan, Haggerty. That's the horse race at the moment. Who's in the lead?
Well, what we know is that the president is very picky right now when it comes to this. And our colleagues and myself last night reporting, we still do not know a name. I would say potentially I would lean into Kevin Walsh and Scott Bessent, because we had reported that people around the president thought that those two could be paired very well in terms of maybe Fed and then the National Economic Director. And then in 2026, they both can move on to other jobs, going from Treasury to Fed for Walsh to NEC to Treasury for Bessent. There's a lot of 3D chess going on in Mar-a-Lago, but what we know is that the president has yet to find his perfect Treasury pick.
Either way, it makes great TV, and I think a lot of people are very excited to see how the horse race continues. There is this overlying reason why people are so focused on it, other than just the drama. It's the idea that it really will telegraph the sequencing of some of the policies and how they're going to be put in place, whether we get tariffs first, how significant they will be, and whether they actually are being used as negotiating tools rather than an end in and of themselves. And that, I think, is what people are looking for in this pick.
What's prime time for TV? Weeknights, Thursday night. Feels like a Thursday night announcement, right? Doesn't that make sense going into Friday?
I don't know. What is it? Is it prime time or prime TikTok? Prime Instagram?
The president-elect is an executive producer at heart.
100%.
Feels like a Thursday night, Sunday morning kind of decision, no?
Yeah, I think, well, if it's Thursday night, I think he would want it for Friday morning shows to talk about markets opening up, going into the weekend. Maybe if he wants the Sunday shows to talk about it, he drops it just before Sunday morning, kind of, rejigs their guest lineup. Let's see. But you're right.
Oh, my God.
He could be producing this all.
Promo's laughing. This is all about casting.
I know it is.
Selecting people from central casting.
Who's handsome.
Yeah. That is a factor. No one denies that.
No one denies that. But, honestly, it's a good marketing tool. And essentially, it makes people pay attention. And maybe that's the new political regime that we're in.
It's truly gripping stuff. That's for sure. Here's the lineup this hour. Coming up on the program, we'll catch up with Gargi Chaudhuri of BlackRock as Nvidia fails to meet some very lofty expectations. We'll speak to Monica Guerra of Morgan Stanley as Trump's Treasury pick remains in flux. And we'll catch up with Samantha of Goldman Sachs on why gold is heading back to 3K. We begin this hour with stocks little changed as Nvidia recovers after failing to deliver on very, very lofty expectations. Gargi Chaudhuri of BlackRock saying this: Mag 7's earnings premium is forecasted to compress in quarters ahead. The gap is set to narrow, a catalyst that we think can further the broadening out trade in 2025. This underscores our preference for a sector-neutral approach to quality rather than tilting more deeply towards tech. Gargi joins us now for more. Gargi, good morning.
Good morning. Great to be here.
Just explain to us, and good to see you, what you mean by broadening out. Is that domestically here in the United States? Does it include international? How are you thinking about that process?
Absolutely. So we're definitely thinking about that very much in the U.S. I think over the next few months, what we're going to see is continued outperformance of U.S. equities over the rest of the world. Within that, one of the things that we've been focusing on, especially over the last month or so, couple of months, is just seeing this earnings growth coming through, not just in tech. So it's certainly not away from tech, but broadening out besides just tech. So thinking about areas like financials, which obviously this year this quarter have had a close to 10% earnings growth, earnings surprise. Looking at things such as broader, looking at very specific value sectors, which again are closing the gap to growth. So I think that's the trade there. Don't move away from tech, but consider other parts, especially of value, of large cap value specifically, that we think can have its moment for the next couple of months.
Without a doubt, financials are in focus. So let's sit on that sector just for a little bit more. There seems to be some exuberance. This idea that the incoming administration can unleash this huge burst of capital markets activity. Is that how you're thinking about it? Is this unexpected policy changes or is it something else?
No, I think it's something else. And we were talking about financials. If you look back to our fall investment outlook, we were talking about IAI and broad BLCV as two of the tickers to play that financials trade, even from September, where we obviously didn't have an idea of what the regulation or the deregulation would look like. It was much about the expected earnings growth coming back, M&A activity coming back, maybe a little bit of steepening of the yield curve, which we certainly haven't gotten so far. But if that does arise, that could be better for banks as well. And of course, I will say that now there might be a little bit more tailwind from expectations of deregulation. But that alone does not make the trade. You have to have the earnings growth, which we're beginning to see. And we're beginning to talk about that all the way from fall.
We are seeing the earnings growth in financials. You point to another area that hasn't been as loved that you like, which is small caps, because of some of these dynamics. And what I find fascinating is there was a time when the yield curve steepened that was bad for small caps. And when you saw the long end of the yield curve go up, that also was negative because these are the more leveraged companies that weren't necessarily profitable. Why is this time different, given that people still expect yields to remain high?
Yeah, actually, we're very focused on large caps. We're telling investors probably move away from small caps a little bit. I think small caps have had a few periods of outperformance. It's very hard to see that sustain. We've certainly seen the flows into IWM, but we don't think it's going to be a lasting and a sustained rally. Exactly to your point, Lisa, it's hard to yet see the profitability come through, where much of the index, much of the small cap names are still suffering from pretty high yields. I mean, yes, yields have begun to come down. The Fed has lowered rates, but if you look at what's happened since the Fed has moved rates, long end rates are higher. So small caps are not able to benefit from rates coming down. And as of right now, we think any rally in small caps can be short-lived, and investors are and have been playing that via upside and call options and IWM, as well as, focusing on ETFs, which you can sort of get in and out nimbly with, but I don't think it's a sustained rally.
And that's one reason why I think there is some skepticism. But at the same time, when you start looking at active management, which I know you're a proponent of, how much are you actually looking at companies that get most of their revenues from the United States and that might not be as exposed to tariff regimes and some of the other policies that could come down the pike?
That's exactly right. And that's obviously something that we've been focusing on more recently with respect to some of the active managers that are focusing on U.S. policies and where can we, especially whether it pertains to manufacturing, focusing on friendshoring and reshoring, whether it also looks at tech independence as a theme. Obviously very top of mind, especially given some of the news from last night. But all of that is pointing to my opening comment that U.S. first and U.S. outperformance or the U.S. exceptionalism will be with us for some time. And we're certainly telling investors to step out of cash into U.S. equities, keeping a focus on large cap and quality with that.
We already see the markets, though, pricing in a lot of Trump policies. So when they actually come down the pipe in 2025, potentially, is that a sell moment or do you want to get more invested?
One of the things that I was just talking to a client about is this isn't just about the election. So I think if we look back coming into sort of the second half of this year, we had three things going for us. One was much stronger than expected GDP. right? So getting that 2.8%, expectations of a high twos based on at least the GDP Now forecast. So that was one. You had this strong growth backdrop. On top of that, earnings, the corporate fundamentals continued to be very strong and, if anything, surprised to the upside. And then the last factor was that the Fed has, again, begun easing. They have told us that they still believe we're in restrictive territory, which means that they're poised to cut more. All of that is actually very good for risk assets. So this isn't just about the elections. This isn't about the GOP sweep. It's very much about the fundamentals being a very strong underpinning of this risk rally we've seen.
But Powell also opened the door to maybe pausing in December, or at least the market has interpreted as such. So how do you think about the Fed for 2025?
Yeah, I think that's a really important point. I think they did open the door, I would say, to not being in a rush, not being in a hurry, to use his terms. I don't know if that necessarily applies to the December meeting. I would like to see them conduct another 25 basis points of easing. And then next year, I think it depends on how sticky inflation continues to be. Lisa, you made that point around inflation. We saw another 0.3 in core CPI. I don't think that sits well. If we don't see that deceleration come through in OER and broader services inflation, I think that allows the Fed to be a little bit slower in their approach. But I do think front end of fixed income and locking in yields, you've got this incredible opportunity to own securitized assets, to own high yield at these all-in levels of 6.5%, 7%. And the Fed has allowed that to happen or given us this amazing opportunity. I think that makes sense for investors.
To wrap it together, there's this question Mohamed El-Erian really crystallized, which is the economy in the U.S. he sees as bigger but not hotter. This idea that it could grow and that you could see that investment, the Industrial Revolution, without necessarily an explosion of inflation. Do you see it in that way?
I think so. Based on the data that we have at hand right now, we think that the U.S. economy, again, given our expectations, think back to 12 months ago. Many of us thought that we could have gotten the recessionary outcome, right? Yep. Not only did we not have that, but we had 7 straight quarters of above-trend growth. On top of that, you have a little bit of deregulation, you have a little bit of fiscal policy, and yes, some concern around tariffs, and maybe net-net, you end up having growth with still above potential at a time when interest rates are normalizing and corporates are strong.
I was going back over your last appearance back in September. Don't worry, nothing to be nervous about. I often do that. And I was going back to September and I was thinking we were having a discussion about the start of a rate cutting cycle. And here we are a few months later talking about the end of one in December. How quickly this cycle keeps moving one way and the other over the last 12 months.
No landing, hard landing, soft landing, no landing, hard landing, soft landing. I mean, basically, we've been on this repeat. It does seem like an increasing number of people are saying their views for stickier inflation now doesn't have to do necessarily with Donald Trump, but just that the data has been better and that maybe this is a more resilient economy.
You know what stands out to me in Outlook season so far? And I've read many. I know you all have. This is what stands out for me. If you look for the forecast for bond yields in 2025, I can't find a single person that thinks we're going to 5%. In fact, the top end that I see was from SocGen, and I haven't read them all just yet, so if you know of one, point it out to me. But the biggest I've seen is 450 over at SocGen, and they think that's the upper end of the range.
I have not seen one person raise the specter of a rate hike. I have not seen one person raise the specter of real acceleration in inflation. A number of people keep pointing out that tariffs tend to be disinflationary, even outright deflationary, when in practice in prior uses. Fascinating if you are a contrarian to look at that.
Gargi, good to see you. Great to catch up. Thank you. Gargi Chaudhuri there of BlackRock. Let's get you an update on stories elsewhere with some breaking news with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. The International Criminal Court has issued an arrest warrant for Israeli Prime Minister Benjamin Netanyahu and former Defense Minister Yoav Gallant. The ICC accused the two of crimes against humanity and war crimes. The ICC unanimously rejected Israel's appeal. That warrant means now that the ICC's 124 member states would be obliged to arrest Netanyahu and Gallant if they were to enter their territory. Netanyahu has previously called the ICC's application for arrest warrants absurd and false. Ukraine's Air Force Command says that Russia launched an intercontinental ballistic missile at the Ukrainian city of Dnipro. The strike, if confirmed, would be the first use of an ICBM in combat since its development during the Cold War. Ukraine claims the missile traveled over 600 miles and damaged an industrial facility in the city. The development also follows an earlier report of Ukraine firing UK-supplied long-range missiles at Russia for the first time. Bank of Japan Governor Ueda hinted that the central bank might discuss raising interest rates at its next December meeting. Around half of economists predicted a rate hike in the country in 4 weeks. Ueda reiterated that the bank will watch the impact of foreign exchange rates on inflation and the economy. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the search for Treasury continues.
I want to see exactly who's in that role because the tax policies, the debt limit all come back. They need to have a conversation with Capitol Hill. And we need to see exactly how that person has a relationship with the Federal Reserve.
We'll catch up with Monica Guerra of Morgan Stanley and get you the latest reporting from Anne-Marie in just a moment. From New York, good morning. I tell you, check out Nvidia. That move's getting bought. We're down now by only 0.7% on that stock, and equity futures starting to drift higher as well. On the S&P 500 up by 0.33%. Under surveillance this morning, the search for Treasury continues.
I want to see exactly who's in that role because the tax policies, the debt limit all come back. They need to have a conversation with Capitol Hill. And we need to see exactly how that person has a relationship with the Federal Reserve. It's going to be a cabinet that was probably somewhat similar to the first administration, where there was a team of rivals.
So here's the latest this morning. Donald Trump has yet to solidify his pick for Treasury Secretary. The president-elect holding interviews at Mar-a-Lago with top contenders including hedge fund executive Scott Bessent, Apollo's Mark Rowan, and former Federal Reserve Governor Kevin Warsh. Senator Bill Hagerty of Tennessee remaining a dark horse candidate for the job. Joining us around the table, Monica Guerra of Morgan Stanley. Monica, welcome to the program.
Yeah, thanks for having me.
The to-do list for whoever this person is so long in 2025. Have you established any underlying assumptions on what the sequencing will look like, what the emphasis will be, how long the timeline is? How are you thinking about those things?
When we're thinking about just policy generally, right, it is about the magnitude and pacing. So, for example, if there are policies that drag on the economy, right, on markets, that could essentially be exacerbated if it's then followed by inflationary policies. So we're essentially going to be tracking that rather closely, especially as it relates to some of these picks.
When it comes to these picks, I mean, we'll have to wait for that, right? It's really narrowing down, I think, to 3 out of the 4. But what is going to be the first job of this individual? Is it going to be maybe pushing back on some of Trump's impulses when it comes to broad tariffs, or is it going to be going down to the Hill and trying to get that extension of TCJA?
So what's going to be interesting is that Congress, the way that it's structured, is going to be really battling out over these details. So even though we have a unified government, the thin margins in the House essentially mean that the negotiating around the tax agenda is going to be critical. And so the next Treasury Secretary is going to be a part of that, equation as far as figuring out what is the point where essentially the debt and deficit becomes untenable. So that number is what they're going to have to suss out through their initial conversations.
With such slim majorities that the Republicans are going to hold, do they potentially maybe get Democrats to vote for this if they include things like an expansion of SALT or an expansion of the child tax credit? You're laughing, so I think that's a no.
Yeah, I would say no, right? That they have a majority. Even though it's a slim majority, they have a majority. And it's just going to be about the party coming together on what those priorities are. So maybe we actually don't see every single thing in TCJA get extended. Maybe it's you have an argument over how low do we cut corporate taxes. And so it's going to be those details that we see essentially get fleshed out in those first 100 days.
When you look at the makeup of Congress, do you see individuals that maybe will push back and say, we have to get our fiscal house in order?
Yes, I mean, you see that initially with the, a selection of John Thune, right, as majority leader in the Senate. So the House side, you have Johnson, who is still trying to negotiate and get business done. And then in the Senate, you have Thune, who's old guard, if you think, right? He's essentially one of the last man standing, right, of that old tradition. And so we do think that there is, I think, pressure from the top to move quickly to try to get these negotiations done as they head through 2025.
Based on who has been already selected for different cabinet positions, do we have a sense of what the priorities are and what the order they will be rolled out in by the Trump administration?
I mean, I think it's pretty clear that the immigration piece is going to be one of the first sort of day one issues that has, essentially is under the purview, right, of the executive branch. I think that there are, legal frameworks that come into play that could slow down maybe the pace of their action, and that we get a less aggressive approach than initially, considered. And then deregulation is going to be on the agenda from an executive branch perspective. And so that, does give us, again, that pro-growth policy piece. So our view is that even though there is this potential, the way that we've been thinking about immigration, tariffs, deregulation, that they're in these big magnitudes, that the reality is actually going to be much more tempered, and that you're going to get something that is more tolerable to markets and the economy over the long run.
So just sticking with immigration, do we have a sense of what it will look like in practice? Because for billions of people to actually be deported, it would take actually a budgeting of $1 billion. That's according to some estimates, to actually get the infrastructure in place to do that. Do we have a sense of what could actually get done and how that would affect the population? And the reason why I ask is because from an economic perspective, this has actually been a big question mark.
Yeah, and you citing 1 billion people is exactly what I'm talking about as far as large magnitudes that are out there. I've heard everything from 1 billion down to, 400,000. And so if you're looking at a more realistic 400,000, because annually you get about 300,000 folks that are deported through the legal system. So is that 400,000 in addition, or is that ultimately on a net basis 100,000 in addition? So it's really, how are they going to be messaging this? And so that's what we're going to be watching. And I think that the actual practicality of it, as far as moving these cases through the court system, is going to be at a much more tempered level.
I don't like to advocate for certain policies, but I think it's a view we probably all share. I hope they do something about legal immigration. The process in this country, believe me, I've gone through it, is so difficult. And if I wasn't as fortunate to have the attorneys that we have access to at a company like Bloomberg, I would find it even harder. I don't think I'd be able to do it. It's that hard.
When I've talked to tech executives, they say we need the H-1B visa to come through. When I talk to other executives, same thing. And at a certain point, you have to wonder, this is an administration that has recently sounded more amenable to that. Will they move that in parallel to some of these other immigration policies that they're rolling?
Well, on the campaign trail, Trump said the foreign students who are graduating from top colleges, especially things like science, math, and they get a degree,
staple a green card to
they
them.
should get a green card along with it.
Yeah, saw that comment on the campaign trail a few times. Monica, it's good to see you. Appreciate your time. Thanks for being with us. Monica Guerra there of Morgan Stanley. The race for the next Treasury Secretary. This is what's important. Framing this almost perfectly, Marko Kolanovic, remember him, formerly of JP Morgan? This is what he had to say. The issue in selecting Treasury Secretary is not who can enact changes, but who can best manage the market response, the volatility that could undermine those changes. I think that is so important. It's not about who can push the policy. It's about who can deal with the consequences of it, given the policy shift we might see over the next year.
Which takes a lot of massaging to be able to communicate it and to make it sound amenable on a day-to-day basis when some of these policies are inherently volatile, and we've seen some pretty volatile reactions in the past.
Which is why you need a real market technician in a moment like this one. Which is why I'm encouraged to see names like Bryson and Rowan doing the rounds.
Are you about to make an endorsement?
Of a particular candidate?
Yeah, I thought that's where you're going to go.
I've said what I think about the list of those four names.
Are you going to order it?
Are very, very strong names.
Let's see your lid.
That's all I'm going to say.
Okay.
Okay. Up next, Jason Draho of UBS on the outlook for 2025 from New York. This is Bloomberg. 2 hours away from the opening bell in New York City, 60 minutes away from some jobless claims in America. Equity futures right now positive by, let's call it 0.25%, recovering on the Nasdaq 100. We'll get to the why in just a moment. The Nasdaq is up by 0.2%. The small caps up by 0.6. With 2 hours until your cash open with your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Maybe we've all become a little bit complacent expecting these drop the mic moments from NVIDIA. This stock was down 5% at one juncture yesterday evening. We've clawed all our way back, the pre-market this morning since we went on air. What is our complacency? This is a company that delivered a revenue growth of 94%. How does it extend that? The margins, you're complaining about a 73% margin level. That will get back to 75% next year. The demand for Blackwell is staggering, according to them. We caught up with Frank Lee a little bit earlier on from HSBC. He's one of the few that's actually cut his price target from 200 to 190. He still has a buy. The silver lining is the ramp up in Blackwell. So we have traveled all the way back up, and that is giving you a little bit of heft to the overall index. By the way, the dominance, it's sustained dominance with those four hyperscalers, has gone from 70% of the revenue to 50%. Dear, don't forget, President-elect warned 200% tariffs to come on anything you sell into the United States of America. The bottom line is this company has managed to eke out a small gain despite the guidance that they gave to the market this morning. They're going to make 5 to 5.83 billion. That is a bit lighter than the market had anticipated. Maybe some of the bad news is already in there on the possibility, the risk from tariffs. Of course, the rhetoric can be sometimes more aggressive than the actual fact. We know that. Let's roll it over and finish off with Snowflake. How do you collate all your data, put it all in the one place, all at the one time? That's pretty much what Snowflake does. You've got 542 customers spending over $1 million each, and the revenue is the rampway. It's the rampway to the cloud, excuse the pun. $906 million to $911 million. This is a relief, I would say. Piper Sanders said investors were frigid going into this numbers, but this is about stabilizing in demand. Jonathan, good morning.
Manus, good morning to you, sir. Looking forward to catching up with you again in about 1 hour from now. Manus Cranny there. Under surveillance this morning, Nvidia revenue continues to surge, but it's not enough for markets. The AI giant failing to live up to some lofty revenue expectations, but assuring investors its advanced Blackwell chips are still on track to ship this quarter. We were talking to analysts yesterday about what to look for. Look for how the market responds to the numbers. Initially down by 4 to 5%. Lisa, it got bought. We're down by only 0.8% this morning.
There wasn't that much to dislike. I mean, doubling revenue in terms of fourth quarter expectations, talking about just the incredible rise that you've seen in adoption and the fact that demand is far outstripping supply for the Blackwell chips. You have to think people are trying to nitpick about the consolidation of the hyperscalers as purchasers, but at the same time, they're minting money, and it's not clear that they're going to stop minting money, and I think that that is the response you're seeing.
You look at me, but this is, you're trying at the margins, as you say, trying to find reasons to not like this. I love this stat. They've only missed analyst estimates on a quarterly level once in the past 5 years. The bar is just too high for this company. But Dan Ives, Bloomberg Intelligence, got it right. Maybe not exactly. It's not green yet, but we're on our way to the stock being green again.
68 buys, 7 holds, only 1 sell now. Just 1 sell.
Who?
I'm not going to call them out,
Oof.
but just 1 sell. Elsewhere, the Port of Los Angeles moving record levels of imports last month as businesses prepare for heavy tariffs under a second Trump administration. The executive director, a good friend of this program, Gene Soroka, saying 905,000 containers passed through the country's busiest port in October.
And this is supposed to be actually more of a quiet time for ports. You already see companies build up for the holiday. This is about going into next year, and potentially it's a double whammy for these ports and these companies. And they want to build up inventory. Why? Because you're really unclear about how far President-elect Trump is going to go when it comes to things like tariffs. Then January 15th, that's the new date for the port workers and this strike. Do they go on strike? Do we potentially see port workers on the eastern seaboard saying, we're not working, and then we replay this all over again?
It's so hard to run a business in this environment, and we saw evidence of that. An inventory disaster over at Target just yesterday, with that stock cratering in yesterday's trading.
That's exactly where I was going to go. It just shows the hazards of stockpiling ahead of potential tariffs. And I wonder if that hazard is more in certain industries, which is the reason why people are looking at retailers in particular that have really struggled through fickle taste and the pandemic and stockpiling disasters after stockpiling disaster, and investors are running out of patience.
That's the danger in the sector for the next few months. Some inventory landmines for a couple of names, not for the whole industry, but just some select names. And we saw that with Target yesterday. We didn't see it with TJX. And of course, we had decent numbers from Walmart as well. I want to finish on this story. Elon Musk and Vivek Ramaswamy looking to force federal workers back to the office. The pair leading Trump's new Department of Government Efficiency, or DOGE, say the move will lead to a wave of terminations, writing in the Wall Street Journal, if federal employees don't want to show up, American taxpayers shouldn't pay them for the COVID-era privilege of staying home.
So I will say this might actually be a welcomed opinion piece for D.C. Mayor Bowser, who's asked President Biden to bring federal workers back because you have less of a local, robust economy when it comes to restaurants. You also have office vacancy rates that have been an issue in Washington, D.C. So this actually might be welcomed in Washington, D.C., but a lot of federal employees actually the majority, work outside D.C., and maybe that's potentially going to have a little bit of a fight with the incoming administration.
The majority of federal employees actually go to work every day. And I think that that's an important kind of gut check, because more than half already work in person because they're food safety inspectors and healthcare workers that have to physically be there. Of the rest, even those who do work remotely some of the time, an average of 61% of their hours are in the workplace. They still are going to the office. My question is, number one, do you get the attrition you're looking for? Is this their sort of big idea to try to cut some
Without
staff?
a doubt.
Okay, but number two, do you get the attrition that you want? Because at a certain point, you have to wonder, is there a coherent look at which agencies have which people that are actually important for the functioning of government?
It's a very important point, and I guess we'll find out, because we're going to see this experiment play out in real time.
Yes, we will.
Over the next 12 months, potentially. Looking ahead to the next 12 months, UBS expecting slowing but solid growth in the United States. The team writed the following. Our base case for 2025 is benign growth in the US, still near or above 2%, but moderating from the pace this year. We expect the Fed to cut rates by 25 basis points in December and another 100 in 2025. Jason Draho of UBS joins us now for more. Jason, good morning.
Good morning.
Got to start with December before we get to 2025. Yep. Some people believe that the communication from the Federal Reserve is starting to change. It's shifted over the last few weeks, and it might be consistent with the pause in December, reinforced by the incoming data. How do you see things?
I think they're still going to be data dependent. Let's see what the November data with inflation and jobs play out. It's still going to be noisy because the after effects of the October data being distorted. A lot of focus on Powell's comments a week ago, like, we're very patient. But it was very consistent with what he said at the FOMC. So I think there's a little bit of maybe reading too much into the shifting narrative or looking for breadcrumbs of what they might do. I think my inclination is they would still want to cut unless the data comes in really hot in some way.
Let's set some thresholds. Here's the calendar. December 6th payrolls, 11th CPI. Let's start with payrolls. I'm looking at the estimates on the terminal. There aren't many right now. I can pick out one from Brett Ryan over at Deutsche Bank, 175. What's really strong for November, given the bounce back we're all looking for? What's strong? What gets them to back away from a rate cut?
So probably something over 200,000 plus the prior months are revised higher. So October ends up being not like 11,000. It ends up being something in the neighborhood of 100,000 plus. I mean, that seems unlikely, but something along the lines of what we saw when we got the revisions, for the September numbers and the summer numbers are revised higher. So something pretty significant there. But I think that's probably not the labor market that's going to cause them to pause. It's more if core inflation, for example, ticks up on the high side. And then you're looking at core PCE, by the time we get into December, is getting close to 3%. I think that's when they start to get iffy. As long as it's staying below 3%, I think they still move forward.
When you extend out, there's a real question about what the highs and the potential lows are for, say, 10-year yields. And we were talking earlier how very few people are calling for 5% or even higher 10-year yields. Yet you say that the most underpriced market scenario is actually the opposite. It's continued disinflation. And this idea that you could see yields just continue to drift lower with Fed that keeps cutting rates. Why do you think that is the more underpriced scenario?
Well, I think it's a situation where investors are looking at what are the policy implications of the Trump administration. You're talking about potential tariffs, maybe high tariffs, worried about tax cuts that could be stimulative. All that could be inflationary. And so I think people are focused on the upside tail risk for inflation, not that perhaps they're actually surprised by not doing significant fiscal expansion. Perhaps tariffs aren't that significant. Inflation continues to go lower. If that happens, the economy cools, the Fed keeps cutting, rates could go lower. So I think it's just more of where investor focus is, much more on the risk of going upside versus things could actually be okay. And that might just be reasonable hedging scenarios. But I think as a result, there's just, I think an under amount of confidence in things could actually be okay on the inflation and rate front.
So there are a lot of implications in that for risk assets. If you have cooling growth, that's kind of the opposite of what a lot of people are pricing in on the equity side of things, on the credit side of things. Are you less bullish on those sides while getting more bullish, say, on bonds?
I would say moderating, not cooling, and these are semantics, but going from 2.6% growth to say 2.2, 2.3, something that's still again around the 2% or a little bit higher. So I think it's a still robust kind of economic environment. To me, if you have that, you have inflation going lower and you have the Fed cutting rates, that's a benign macro environment. All else equal, that should be good for risk assets.
You say that potentially people are thinking it's too inflationary. It might be less inflationary, some of these policies we might get from Trump. But what about the retaliatory measures we can see from some of these countries, even if the tariffs are not as big as some are expecting?
Well, then you have to think about from the U.S. perspective, how inflationary are tariffs? So the estimates from, say, 2018 was at 0.3%. Now, if the tariffs are bigger this time, then you could be talking about a bigger inflation impact. You'd get probably measured responses by other countries. from an overall inflation perspective, this kind of is what for the Fed. If this ends up being like a relatively modest tariff shock, the Fed's going to look through that. They're going to think this is like a one-off increase in the price level. It's not going to deter them. So as long as the underlying components and sort of drivers of inflation are still disinflationary, I think it lets the Fed keep going. That's why we're sort of still sticking with 25 December and also 100 next year. I mean, obviously it could be less, but I think, the markets are down to only 3 cuts. I think that's a little too extreme at this time.
We hear a lot about tariffs, cutting of taxes, deregulation. What about immigration and this potential for deportations? What can that actually mean for the labor market?
Well, what we know is the past couple of years, the immigration surge has been positive for growth. All is equal. It's probably been positive for wages coming down, inflationary. I think what the administration, or the incoming administration, is like to do is certainly curb legal immigration to some more moderate level. Given that the backlog of, from an economic perspective, the backlog of people who've immigrated who still haven't worked, I think there's still a positive immigration story into the labor force probably well into next year. You're looking at maybe by 26 where that's going to really start to perhaps impinge. And I think it's hard enough to predict next year, let alone 2026. So I think that's a story for down the line, but it's probably not a key driver for the macro outlook, at least for the next 12 months.
In your macro outlook, you go to what we've heard from Ed Yardeni, which is the Roaring 20s, and you say there's a lot of evidence that we're in the Roaring 20s. And I keep wondering how much of some of these year ahead outlooks actually, how much have they changed from the election that we've gotten in the United States? And people have been pushing back against that. How much of your benign outlook really does hinge on what just happened versus just the momentum that we're seeing play out in economic data that's backward looking?
I'd say if we sat here a month ago, our benign outlook would be the base case. What's changed is, I think, the range of outcomes. So the tails have gotten fatter because just the policy, whether it's extreme on tariffs, larger tax cuts, or perhaps, there's, they don't go as extreme on those measures, and there's actually, benefits on deregulation, things of that sort. So I think the range of outcomes, the tails have gotten fatter. To me, the base case hasn't changed, but because ultimately, again, we don't think it's going to be the most extreme situations on tariffs. We think on tax cuts, they extend the existing tax cuts, but the deficit is just too large for anything more significant. Stimulus. And the bond market this time, maybe more so than the stock market, could be what incoming President Trump thinks about. But I kind of think of it, there's a Trump put, but not so much on equities, but on treasuries, because if rates rise too much, the equity market's going to be responsive. So that might be sort of the novel thing this time. And I think that's going to be the discipline more so than the equity market.
You talked about the balance of risks around the base case. Can we just finish on that? If you believe the balance of risks around the base case have shifted, and you're in the position of a policymaker who has to manage risk, shouldn't you approach the policy shift as well?
So I think ultimately the right policy is probably don't make two extremes either way, right? And kind of staying the course, to me, with modest adjustments at the margin is probably the best thing, because then the macro environment sort of plays out with growth is still solid, inflation comes down, the Fed cuts rates. You get rid of the uncertainty that can impact businesses. It's hard to plan when there's uncertainty. So I think not extremes, to me, would be the best outcome for the economy. I think for the markets as well. Like the markets don't like uncertainty, don't give uncertainty, right?
Jason, it's good to see you. Appreciate your time. Thank you. Jason Draho there of UBS, looking ahead to the next 12 months. We'll do a lot of that over the next few weeks, and then we'll finally get to year end and we can enjoy some holidays. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The White House is seeking to forgive half of a $9 billion loan to Ukraine. According to a letter obtained by Bloomberg News, the Biden administration told Congress that it plans to cancel $4.65 billion of the debt owed. It's another move to support Ukraine before President-elect Trump takes office. While Trump has said his priority is pushing Russia and Ukraine towards peace negotiations, there still is a concern that he might cut off aid as part of that push. Bitcoin is nearing $100,000. It's currently just under $98,000. Optimism on President-elect Trump's crypto support and MicroStrategy's plans to accelerate purchases of the cryptocurrency fueled gains. People familiar also said that Trump's transition team is holding discussions over a White House crypto role. The market itself has gained $900 billion since Trump's election win. Now, speaking of crypto, digital currency entrepreneur Justin Sun bought a piece of conceptual art yesterday at Sotheby's for $6.2 million. The art in question, you can see it there. It is a banana duct taped to a wall. Titled Comedian, it debuted at Art Basel Miami Beach in 2019, where attendees there couldn't figure out if it was a joke or art. Sun said the piece, quote, echoes with our idea of decentralization in the crypto world. Because this is conceptual artwork, it's impossible for you to destroy the artwork itself. That's your brief, John.
Well, you can eat it, and people have done that. And Danny, thank you. And I'm sure you've all got the same question, so I've got an answer from Vogue magazine, tremendous publication, who say this: what happens when the banana goes bad? We all want to know. Apparently, the owner can replace it. according to the artist's instructions. There you
Sorry,
go. Okay?
I can't even.
Isn't that the question we've all got?
I actually did an art project in college where I put bananas in a bag and people smushed it and then I hung it and I got a bad grade on it.
No comment. No comment to Lisa's
Perhaps
bad
best.
artwork.
Best not to comment on this one. Up next on the programme, going for gold.
Ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold. I still think $3,000 an ounce is kind of the target for next year.
$3K for next year, echoing that call. Goldman Sachs up next. Live from New York City, welcome to the programme. Equity futures on the S&P 500 recovering as the session grows a little bit older. We're positive by 0.25% on the S&P 500. Under surveillance this morning, going for gold.
In the short run, we think gold could go down to $2,500 an ounce. And part of it is just that those tariffs, the downside risks. We're also seeing interest rates going up in the U.S. These are important elements for gold because gold was pricing in a pretty steep rate cut path. If that doesn't happen, it's going to be choppy for gold for a bit. Ultimately, if inflation comes back, gold will be a good place to be. So I would say maybe buy the dip in gold. I still think $3,000 an ounce is kind of the target for next year.
So here's the latest this morning. Gold catching a bid through this week, rising alongside demand for haven assets as geopolitical risk and policy uncertainty hits markets. Samantha Dart of Goldman Sachs writing, U.S. policy uncertainty and recent consolidation provide an attractive entry point for our high conviction long gold view. We keep our view at 3,000 for the end of 2025. Samantha joins us now for more. Samantha, good morning.
Good morning.
Before we talk about where we're going, I think we need to talk about where we've been and where we are right now and what's behind it. You've identified a whole host of tailwinds for gold. Central bank buying, fiscal sustainability, trade tensions. Of all of the reasons, what's the dominant factor for you in 2024?
Yeah, it's central bank buying. In fact, it's been the dominant driver of the upward gold move since 22. The moment that Russian financial assets were blocked, then that sparks a lot of concern from a lot of emerging markets and China in particular that, who knows, this might happen to them one day. So central bank buying has stepped up significantly, fivefold from the average that we observed prior to 2022.
Do you see that continuing in 2025? And do you see policy changes in the United States that will just exacerbate some of the trends that we've seen?
So on the EM central bank buying, we definitely see that continuing. When you think about how much reserves they have in gold, it's still very low compared to what DMs hold. So the structural driver is there. But I think on top of that, the other interesting story is that for the longest time, ETFs were not a part of the story. And I think the moment the Fed started cutting, then that's what opens room for ETFs to come in as well. So when you think about physical buying in this market, central bank buying is the primary driver, but now you have on top of that the cyclical support from ETF buying as well. So safe haven is just the cherry on the top, right?
So this is actually a really important point at a time when sometimes when gold goes up, people call it an inflation hedge. Sometimes people call it a haven trade if there's geopolitical risk. Are you saying that that's all just creating a narrative around a fundamental structural story that's playing out with central banks and what they're doing with gold?
Yeah, I think especially the safe haven aspect is very much a part of the risks ahead. There is a lot of policy uncertainty ahead. Clients have been very focused on, will there be a tariff escalation scenario? And that can bring uncertainty, and that's usually what triggers higher positioning and that notion of safe haven buying.
Well, I guess that the reason why I ask it this way is because we're wondering how clean some of the previous haven trades are. We ask that about treasuries, given the fact that people are worried about the deficit. We ask that about oil, given the fact that the supply-demand dynamic has changed, given the renewables. And we ask that about gold, given that there are some other unique benefits. Do you think that gold and oil in particular are still the best hedges for that uncertainty, even more perhaps than other asset classes?
I think even gold more than oil. When we think about inflation, oil is a fantastic hedge when that inflation is coming from a supply disruption, to be sure.
But the risks ahead, I think, include more than that. Yes, there is a concern with what's going to happen to Iranian supply. That's fair. But on top of that, tariff escalation risk, or even, as you mentioned earlier, that growth fears. So I think gold offers more reasons for investors to belong right now. And really what I think the dominant driver has been is this structural support from central bank buying. Just like the sheer tons being bought, and we just got the latest data for September, which shows that high rate of buying has continued. So this is really the primary driver, and the safe haven notion, the hedge against inflation, we think goes on top of it. In fact, when we think about the highest risks associated with tariff escalations, with debt fears, we think this can take prices even above our 3,000 forecast for the end of next year. It's not a base case, but it is a risk that we have been highlighting.
Samantha, when you put all these tea leaves together, especially the central bank buying, is this the start of de-dollarization that we could see bleed out, even in a bigger way, in the global financial system?
We don't see it that way. We see it as maybe a rebalancing of the way that financial and monetary authorities hold their reserves. So just being a little bit more diversified.
I was talking about this, we all have over the last few weeks. I still remember something that I think it was Kashkari said of the Minneapolis Fed a number of years ago when he was asked about the deficit and whether the bond market was starting to get concerned. And he pointed to foreign exchange. And he said something like, the dollar's not getting sold. And if the dollar was getting sold, then you'd have that EM dynamic where you were worried about the deficit. It was showing up in bonds and people were backing away from the US dollar. You're not seeing that again, but you are seeing it in gold. It's the dollar depreciating against gold, which I think a lot of people are flagging over the last few months.
Because it's not necessarily that there's another currency that actually is gaining that haven trade. It is that these central banks are buying gold. And that, to me, is a structural change that maybe you can't play in the currency pairs, but you can play when it comes to the precious metal.
Because where else are you going to go? Europe?
Well, but this is my point. I mean, honestly, I do want to go to Europe, but
no,
not
I want to go to Europe too, for the record.
Especially when it's parity.
I've got plans to go to Italy again next year, keep it at 105.
You said you want to go to Europe.
Say, I don't have trade recommendations, but I'd love it if euro-dollar stayed at 105.
100%. I mean, when you say that, yeah, I would go there. But I mean, what other currency, could you really get your head around?
Samantha, it's good to see you. Appreciate it. We'll let you miss out on that one. You can escape that. Samantha Dowd of Goldman Sachs on gold. Gold going back to 3K, according to Goldman, and according to BofA as well. Coming up on this programme, we'll catch up with the former NEC director, Gary Cohn. Looking forward to that conversation. We'll speak to Dana Peterson of the Conference Board and Kristina Campmany of Invesco. From New York, the third hour of Bloomberg Surveillance. Up next.
We think that the opportunities are mostly in U.S. large cap stocks.
For longer term investors, the debate on NVIDIA is, are they selling razors or razor blades?
As good as this bull market is, any news that sort of disrupts the narrative can cause volatility.
Every time there is increased pressure on NVIDIA, they can always, scale back and deliver.
NVIDIA is 20 times the size of some of these markets. So that's why it's so critical here to portfolios.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City, with equity futures on the S&P 500 recovering higher by 0.25%, a three-day run on the S&P with no losses so far, closing yesterday almost totally unchanged. We're positive on the Nasdaq 100, even with NVIDIA yesterday afternoon down by 4 to 5% after hours following earnings. That stock recovers in early trading. Check this out right now on NVIDIA. NVIDIA stock at the moment is lower, Lisa, but only by about 1%.
Yeah, at a certain point, you have to wonder what was exactly bad in this forecast. They actually beat the average estimate. They just didn't supersede. And even then, I mean, this is a company that likes to sandbag Wall Street. They like to set estimates really low and then blow them out of the water. And people basically see a pipeline that promises to do the same.
That's 2025 and the year ahead for NVIDIA. Basically, low bar, big beat. That's what people are looking for. In about 30 minutes, we're looking for jobless claims. I'll show you the bar. It's 220. That's the median estimate in our survey. The previous week was 217. This data is really quite decent. As you're anticipating the year ahead, you're thinking about policy changes. We need to talk about the lineup to be the next Treasury Secretary. You know the names by now. Bessent, Walsh, Mark Rowan, Senator Bill Hagerty. It's still those four.
It's still those four, and yesterday he was with three of them, and some of these meetings went a little bit late into the evening, and yet he has not come out and decided who he is going to pick. Our story this morning, and alongside reporting with Nancy Cook and Saleha Mohsen, Josh Green, he's looking for his perfect Treasury Secretary. He's very picky about this, and he has yet to decide on one of those names. So now people are speculating potentially, does he go an unorthodox route? There was a list of names he could have chosen from, say, for Attorney General, and he decided to go with someone that was controversial, Matt Gaetz.
Jason Draho just put it really well. The base case hasn't changed for the economic and market outlook for next year. But after the election, the tail has increased. That potentially the extremes of these policies could make the scenario very different one way or another. The reason why the Treasury Secretary is so important is because it'll highlight the risk or not of one of those tails and just how much that could be moderated.
The range of outcomes is like this wide and getting wider and wider by the day. Coming up this hour, we'll catch up with IBM Vice Chair Gary Cohn as markets weigh potential Trump trade policy. Dana Peterson of the Conference Board reacting to jobless claims in about 27 minutes. And Kristina Campmany of Invesco as the Fed tries to buy optionality heading into 2025. We begin this hour with Trump's Treasury pick still very much up in the air. Following meetings with Apollo's Mark Rowan and former Fed Governor Kevin Walsh, investors still waiting for President-elect Donald Trump to make a final decision on the individual who will go into 2025 facing down a huge to-do list. Joining us around the table, the IBM Vice Chair, the former National Economic Council Director, Gary Cohn. Gary, good morning.
Good morning. Thanks for having me.
Good to see you. Thanks for being here. I think we need to take a big step back, in fact, go several years back to 2016, 2017. Just frame for us what you had to face down in 16 going into 17 and how long the to-do list was back then.
So I think we should take even a bigger step back and remember what the environment was. If you go back to the economic environment as we were going through this exact period, we had a environment where we had just barely started to come out of the Fed's zero interest rate policy, quantitative easing, and a decade of Fed articles, will there ever be inflation again? We were just starting to turn that corner. We had come through an Obama 4 years or 8 years of basically saying, you know, there's been a very tough business environment, highly regulated. You know, how do we get business re-engaged? And Trump won this victory. It looks very similar to where we are today, except, you know, Fed funds were 76 basis points back then. They're 4.5% today. National debt was about $20 trillion. We're at $35 trillion right now. So we're in a pretty fundamentally different place. And then as you look where we are today, not only have we a pretty decisively different position in rates and debt, I think the president-elect is walking into an environment with that high interest rate environment where housing prices have gotten really out of touch for most Americans. And there's a real push to try and make housing more affordable. You look at the way Treasury has decided to fund that additional debt. They've been very short-dated on the curve, which I think provides an enormous amount of risk in refunding. And we all worry about refunding of Treasury. So I think we've got to have a real refunding situation where we roll out maturities. You know, I remember talking to the president like 8 years ago about doing a 50-year and a 100-year. I still think we should have done a 50-year and a 100-year when rates were low. And then you think about the situation with state and local governments. State and local governments were not in great position 8 years ago. Now think of what's going on with the migrant population, how much money some of these cities and states have spent on immigrants. Now, they didn't say anything prior to the election, but I will be shocked if there's not a huge outcry from some of the major cities in this country about the amount of money they've spent and how much help they're going to need from Washington to make their budgets come together. So that's where you start. That's literally day one. That's January 20th, 12 noon. You walk into that.
Yep.
So there's a fundamental difference from where we are. But there's a similarity to coming off of the Obama administration versus the Biden administration, the excitement of business, the opportunity going forward. Those are the excitements. Then you go back eight years ago and say, okay, what did we walk into as well? Well, look, the number one policy that we really wanted to get done initially was tax reform. Tax reform was our number one objective. Unfortunately, the House had sort of gotten ahead of the White House. During the last few weeks of the prior administration, the House had gone ahead with repeal of Obamacare. So we walked into repeal and replace without really a replace.
Which I have to admit, I totally forgot about. I totally forgot about the McCain vote.
Yeah.
I'd totally forgotten that you'd walked into that back in 2017. How did that complicate things to get taxes done?
Well, it highly complicated things. We all thought on the economic team that we were walking in, we were going to, January 20th, we were going to start on tax policy. I think all of us got thrown into healthcare, trying to figure out healthcare. None of us were really healthcare experts. None of us had been doing work on healthcare for the prior 3 months trying to get ready to walk in. We'd all been working on tax policy and trying to figure that out. So everyone got derailed for the better part of, I would say, 2 months or 3 months, knowing that we wanted to go through taxes in year one because we wanted to use that budget that existed, and we wanted to use budget reconciliation to get taxes done that year. So every day we were spending on healthcare, we were losing a day of tax policy, which was, it was anxiety creating, let's put it that way. So we were trying to get rid of the healthcare issue as quickly as we could.
What's going to be the priority when they walk in January this time around? Is it going to be tariffs or is it going to be cutting taxes?
So I think there's two priorities day one. On the economic side, and you'll argue there's both economic. I think it's going to be taxes because, again, you've got a deadline. Remember, the personal side of the tax policy ends at 12 midnight, December 31st, 2025. So there is a forcing function. And Washington operates really well with a forcing function.
They need deadlines.
They're
like journalists.
Well, I don't know about journalists, but I know about Washington. They need a deadline. There is a hard and fast deadline. Now, look, they could extend it, but that would be another act of Congress to extend it. So they have a firm deadline in place. So number one thing on the economic policy front is they're going to deal with taxes. Number two is I think simultaneously, we could argue this is economic as well. They need to deal with the immigration policy. I think we will see Trump come back to many of the executive orders and many of the policies that he had going out on January 20th. He will reinstate all of those policies to shut the border and at least stop the flow of illegal immigrants into the United States. So I think they will work on both of those simultaneously. I do think there will be some tariff policy going in there as well. And I think the tariff policy that will be relatively easy for them to go on is to tariff things that we are currently manufacturing in the United States, where you would put tariffs in place to protect jobs and protect the products that we are currently making in the United States.
Okay, so personnel policy, we have 2 out of the 3. We have a border czar, he's announced, and we also have Howard Lutnick going over to commerce. What is going on with the Treasury pick? We have 3 men who I've been told the president thinks are of high caliber. Scott Bessent, Mark Rowan, Kevin Warsh, in Palm Beach yesterday, having these conversations with the president. You know how he operates. Why is this pick taking so long if he ran an economic agenda campaign?
So I think you just answered a little bit. He ran an economic agenda campaign. This is in his opinion, this is one of the most important, if not the most important pick he is going to make. So getting it right is important. I'll also remind you something. We'll go back to 8 years ago. The economic picks were made the week after Thanksgiving. I was hired the week after Thanksgiving. Mnuchin was put into his job the week after Thanksgiving. So the transition team is a couple weeks and probably a month ahead on most of the picks. So, we've all got this anxiety because, look, this is a second-term president, so he knows how to get stuff done quickly. But if you think of what happened 8 years ago, those picks were made in the last week of November, first week of December, and we were all ready to go in our chairs, in place by 12 noon, January 20th. So there's plenty of time to get it right. And I think the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
Do you think it's a name that I have not reported on?
Look, I'm not involved in the process. I think the president will put any and every name that he thinks can do the job well on the list, and he will choose what he thinks is the best person to do the job.
Do you think it's feasible for President-elect Donald Trump to achieve his goals of the tariffs that he's put out there while acquiescing or creating some calm in the bond market?
Look, we will see what actually happens in policy. You know, as I always remind people, what you say to get elected and what you do in actual policy are two different things. You know, Americans like to hear what your ultimate idea is to get done, but we've got a very rigorous policy process in the United States. We've got a House, we've got a Senate, we've got lots of constituencies, and when it comes down to actually executing and implementing policy, it is not exactly what the president wants. In fact, every piece of legislation is a compromise. There's no perfect piece of legislation in America because at some point people have to compromise. So we'll see what the president can get done. I mean, I think we're all confident there'll be something on taxes. We're 100% confident there'll be something on immigration, and there'll be something on tariffs. But again, each of these will be a compromise. No one is going to get 100% of what they want.
I guess the reason why people are so interested in the Treasury pick is because people want to understand what that compromise might look like, and the individual might give some insight into that. Do we have a sense, and will this sort of be the ultimate test for you, how much Congress pushes back on some of the picks that have already been announced that are controversial even among Republicans? Will that be sort of a test of just whether the checks and balances will work at the same time when a lot of people are saying this time is different and that this president-elect actually has something of a mandate that is very different than in 2016?
I think every Congress and every president, when they come in and they put their nominations through and they go through the consent process, it's different every 4 years. Every president goes through a different process. You have a different makeup of a Senate. You have a different sort of body. And by the way, the body will be different at the end of this year, and then it will transition. I think it's January 3rd is the swearing of the new Senate. It will change January 3rd in the middle of the process.
Right.
So some of these nominees could actually go through an approval process with this current sitting Senate. Some may go through with a new Senate. Probably the vast majority will go through with the new Senate, because it takes time to get the paperwork through, it takes time to get the vetting through. But every one of these events is unique, and it's uniquely different because there are different personalities involved. There's different people went through different elections.
Yeah.
Certain states changed. They became redder. So the senator may or may not be more comfortable taking a certain point of view. So you literally have to watch each of these as an individual, unique event.
So you did mention the financing of the deficit. And that's very interesting to me, especially at a time where you talked about the short-term nature of a lot of the financing. Do you expect that to change, for there to be a lot more longer-dated issuance, regardless of where yields are at, with the next Treasury Secretary, whoever that may be?
Look, I think it's really prudent risk management to start elongating the debt of the United States and not have to live off very large short-term auctions and not have to live off a short-term demand for treasuries. Look, we're always worried about financing the deficit and what could happen. Like, as a person that grew up as a risk manager running a large balance sheet for a large percentage of my life, you would want to de-risk that. How do you de-risk that from a treasury standpoint? You roll out maturities as long as you can, so you cut down the amount that you have to fund at each of these auctions. So I would think that this administration would want to get that done and roll out maturities.
Gary, we'll continue that conversation in just a moment. Gary Cohn will be sticking with us. If you are just joining us, welcome to the programme. The S&P up by a third of 1% this morning. With your stories elsewhere, your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The International Criminal Court has issued an arrest warrant for Israeli Prime Minister Benjamin Netanyahu and former Defense Minister Yoav Gallant. The ICC accuses the two of crimes against humanity and war crimes. The ICC unanimously rejected Israel's appeal. The warrant now means that the ICC's 124 member states would be obliged to arrest Netanyahu and Gallant if they were to enter their territory. Israeli President Isaac Herzog called the decision outrageous and a dark day for justice. The U.S. Consumer Financial Protection Bureau will now supervise Apple and other tech companies that offer digital wallets and payment apps. According to a statement from the CFPB, the agency will treat those companies like banks as long as they handle more than 50 million transactions a year. The final rule will take effect 30 days after it's officially published in the Federal Register. UConn women's basketball head coach Gino Auriemma made history last night with the Huskies' victory over Farley Dickinson University. Auriemma is now the all-time wins leader in college basketball history for both men and women with 1,217 victories. That surpasses the legendary Stanford coach Tara Vanderveer. For more than 60 former players came to the sellout home game to support their coach. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, plus a little bit later, Dana Peterson of the Conference Board on the latest US economic data. And in just a moment, more from Gary Cohn from New York City. This is Bloomberg. We are 1 hour and 10 minutes away from the opening bell in New York City. Good morning to you all. Equity futures on the S&P 500 shaping up as follows, up by a third of 1%. In the bond market, pretty soft 20-year auction yesterday, pushing yields higher. This morning, yields back down by almost a basis point, the 10-year 4.40. Time now for some morning calls with just one stock in focus, Nvidia. First up, JP Morgan raising the chip maker's price target to 170, citing strong AI demand and Blackwell production ramping up. Your second call from Wells Fargo raising the company's price target to 185, recommending investors buy the weakness. That's what investors have been doing so far this morning. The stock is now higher by 0.5%. And your third and final call from Morgan Stanley raising Nvidia's price target to 168, expecting a strong Blackwell ramp up through 2025. That's Nvidia. Back with us, the former NEC director, Gary Cohn. Gary, I want to pick up on a conversation we were having earlier. The race to be the next Treasury Secretary. You've been in the room with President-elect Donald Trump many a time, including to interview. What's it like to interview with Donald Trump?
Well, look, it's always a stressful experience. You know, you're sitting there with the president-elect and a large amount of his team. Like, usually when you're in the room with the president-elect going these interviews, there's multiple other people in the room. You know, I always reminded myself, I'm speaking to the president-elect, I'm not speaking to the other people in the room. So you've got to sort of block out the other people in the room. But he's rigorous in his questions, and he tends to go multiple different directions. So, you know, he'll go from topic A to topic B to topic C, back to topic A. It's interesting. You've got to be on your game. When you're in there, you've got to be on your game, and he's thinking, you know, in multiple directions. And it's very interesting. And he's always got an interesting spin on things. You know, I think the president-elect Trump is one of the best marketers and branders I've ever seen. So when I'm always talking about an answer and how I would think of something from a policy standpoint, he's talking about it. How is he going to sell this to America, and how is it going to affect people, and how is it good for the country? And he's thinking of it in that term. So we're always having an interesting conversation where I'm thinking about it from an economic policy, markets policy standpoint, and he's thinking about it from how do I sell this and how do I get momentum for this?
Some space in the media are describing this process as looking for a yes man, someone who will just say yes to some of his policy proposals, including trade. You had disagreements with him on trade. You were very open about that. We were all aware of it at the time in the first term. How open is he to those disagreements?
Look, I believe it's the job of an advisor in the White House to tell the president the truth and tell him things that he doesn't want to hear. Now, you get to tell him plenty of things he does want to hear. You know, like it was always fun to go in there with the economic data. You know, you get the economic data the night before it's released. And there were many nights where I got to go in there and talk to him about the economic data, what it was, how good it was, how the markets were going to react. Those are great conversations. But along with those great conversations, you get to go in there and have conversations that say, hey, look, if we do X, I think the reaction is going to be this. Are we prepared for this intended or unintended consequence? And I think those are the jobs of the people that sit in the White House as advisors, to make sure when the president does something, they understand the intended and unintended consequences. A president should never be blindsided by a decision.
When it comes to the check and the pushback on Trump 2.0, John talked about this his first 4 years all the time, the Trump put. It was the stock market that he cared about. He would reverse course on potentially something he wanted to do, an executive order, just because he saw the fallout in the financial markets. What's going to be that check this time?
I think Trump is going to care as much about the stock market these next 4 years as he did the first 4 years. That is a benchmark that he will measure himself. It's a very public benchmark. It's one that he uses. He talks about it in every speech. He's already started talking about it in the transition, how well the market's done since election night. I don't think that will change over the next 4 years.
Do you think the bond market takes on additional importance? We started this whole conversation about the difference between now versus, say, 2016-17, certainly in fixed income in a very different position.
Look, I think the bond market deserves a long discussion here. I think there's a lot going on. When I talked a little bit ago, where Fed funds were at 76 basis points, where they're 4.5% now, that's only half the story. We had a flat yield curve. And then we've gone through an inverted yield curve over the last 4 years because everyone was worried about a recession. And now we're going back to something that we forgot what it is, called a normal yield curve.
How steep is a normal yield curve?
Yeah, like at least you've been around long enough to ask a question, how steep is a normal yield curve? Because a lot of people don't even remember a normal yield curve is steep. We've seen since the Fed started cutting interest rates, 10 years have gone up 60 to 70 basis points. I'm not surprised by that. I think we're renormalizing a yield curve. If we've taken recession fears off the table and the 10-year is going to go to a normalized rate of, let's call it 3.5%, there has to be at least 100 to 125 basis points of steepness in Fed funds 10 years. I think it's at least 125. If we're going to 3, that's at least 4.25. If we're going to 3.5, we're talking 4.75, and we're going to continue steepness out the curve. And that's before we get to what I consider a pretty large refinancing wall coming up in 25 and beyond. I think many people forgot that, 2020, the COVID year, we did a lot of refinancing in the market, but most of them were 5-year refinancing. So a lot of that COVID paper that was done at pretty favorable rates, because the Fed, again, went into very accommodative policy. Yep. A lot of that COVID paper comes due next year. So we've got a lot of refinancing coming due in 2025. So I think the yield curve smartly and normally starting to re-anticipate what's going to happen in the bond market.
We could talk all morning. Let's do it for an hour next time. It's good to see you, sir.
Great seeing you.
Appreciate it. Gary Cohn there, the IBM Vice Chairman and former Director of the National Economic Council under Donald Trump. Up next on the programme, some breaking data for you. Jobless claims just around the corner. We'll get the reaction from Dana Peterson of the Conference Board, and we'll catch up with Kristina Campmany of Invesco here around the table to react. From New York, this is Bloomberg. Equity futures on the S&P up by 0.4%. On the Nasdaq 100 up by a third. The small caps doing nicely, up by 0.7. Next up for this market, jobless claims in just a moment. The estimate is 220. The previous number is 217. Going into that in the bond market, your scores look like this. The 10-year just about unchanged, around 440. The 2-year just about unchanged also at 431. At the long end of the curve, the 30-year 460.23. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. And the trend continues. 213,000 is the jobless claims number, and that is down from the prior week. Obviously, we saw a revised 219 for last week. Philadelphia Fed Business Outlook Index drops to negative 5.5 from 10.3. The new orders index is at 8.9 from 14.2. Employment, 8.6. That's up from 2.2. And I point that out because there's an interesting aspect to the jobless claims numbers this time, and that is that in September we had a 219, and then we had a very big payrolls report. In October, we had 246, and obviously that was hurricanes related, but we had that very low jobs report in October. So 213 would give you a suggestion that things might be better. And you look at this Philadelphia Fed number, and it is a big drop in the headline calculation for how people are feeling, but the employment number goes up. So if you're trying to put together your forecast for December 6th, these are some of the inputs that you might put into it. And I'm talking about jobless claims because last week was the reference week for the jobs number survey.
213 is just phenomenal. And Mike McKee, thank you, sir. The equity markets as session highs are up by 0.5%, let's call it. In the bond market, yields stay pretty much unchanged to down a basis point or so on a 10-year 440, on a 2-year 431. But just to frame that 213 is ridiculously low for jobless claims in America.
To put this into perspective, it's actually the lowest number going back to April, which is sort of in coherence with a lot of metrics. We're seeing now the fewest number of rate cuts being priced into December rate meeting going back to April. You see the most positive surprises economically in the U.S. since April. It seems like that upward trajectory is taking hold, which is the reason why I find it interesting that the bond market isn't moving more on this. Is that what's already being baked in?
I was trying to dig out the Chairman Powell speech from Jackson Hole, Wyoming, all those months ago in August, and I can't get to the body of the speech quickly enough, but ultimately I wanted to go back to that because in August, at the end of August, there was this real worry that the labour market was starting to weaken, that they wanted to get ahead of that weakness, that they did not welcome any weakness. And this whole conversation around this table shifted, and really quite quickly. It was going to be the beginning of a rate cutting cycle. Would it be 25? Would it be 50? Would it be a string of 50 basis point reductions? Here we are, 75 basis points of reductions later. We're talking about the end of a rate cutting cycle potentially, maybe even a pause in December. There are still some people wondering whether September was actually a mistake. Aditya Bhave of Bank of America came on the programme earlier this morning and said it was. The labour market weakness we saw in the summer was a head fake. That's the view of a lot of people on Wall Street. And the response that we saw from the Federal Reserve was a mistake.
And that's why the tone is changing yet again, at least on the margins. Maybe not Fed Chair Jay Powell himself, but Fed Governor Mickey Bowman coming out yesterday saying she would prefer to proceed cautiously. Boston Fed's Collins saying that while some additional policy easing is needed, they need to be able to go deliberately before they move again. So there's a real question here about whether maybe they've run out of room to cut so easily, and the future is going to be a lot more difficult.
I found that line. We do not seek or welcome further calling in labour market conditions, and we didn't have much of that, let's be clear about it, over the last few months, with the exception, of course, that hurricane-disrupted number that we had in the previous month. Joining us now to discuss is Dana Peterson of the Conference Board. Dana Peterson, 213 on jobless claims. How strong is that number?
That's a really strong number. It means very few people being let go. And I think what's important also is to look at continuing jobless claims. That's a number of people who actually receive benefits and are staying on there, but they're coming off. And indeed, we're not seeing very high continuing claims either. So I think it continues to suggest that the labor market is doing okay.
Are things lining up for a pause for the Federal Reserve in December, or is it still too early to tell?
I think it's a little early to tell. We still really need to see that October PCE inflation data. The CPI continued to show some stickiness, not only in the headline, but especially in the core, even away from shelter. And so I'm sure the Fed will want to see if that also played out in their favorite inflation gauge, which is a PCE deflator. But it also depends on how strongly we see employment bounce back. When we look at retail sales, they were slower, but we had a feeling that they would be in October given the hurricane effects. But even still, consumers went out and spent. So I think that they can probably still go ahead and cut by 25 basis points in December, but next year is rather uncertain.
Especially when we're not clear on some of the inflationary impulses and changes in policy. Tom Barkin of the Richmond Fed, in an interview in the Financial Times, said this, and I thought this was interesting. We're somewhat more vulnerable to cost shocks on the inflation side, whether they be wage-related or otherwise, than we might have been 5 years ago. Dana, this really goes to the heart of the feeling about a neutral rate that is significantly higher in the post-pandemic era, even once we have normalized. Do we have a sense, do you see evidence that maybe we've reached a plateauing in the disinflation? And then when it comes to the wage front as well, that could once again be one of the pressures.
Well, we've been saying for several years now that inflation's probably going to be tougher to beat post-pandemic than before. And certainly you have many more upward inflation pressure. Some of it's structural from demographics, which is also influencing wages. But yes, we continue to have these shocks like onshoring, deglobalization. We could have more tariffs. All those things are highly inflationary and will resist the Fed's efforts to get inflation back to 2% and keep it there. And in order to keep it at 2%, we imagine that the federal funds rate is just going to have to be higher, maybe above 3% going forward in nominal terms.
To throw policy into this, we were just talking with a number of different people who are close to people in the Trump orbit. Gary Cohn was talking about how immigration would be one of the first potential issues to tackle. And I'm just wondering how you factor that into your outlook for the U.S. economy, given that that was one of the reasons why you could see full employment and disinflation at the same time.
Sure. I mean, we don't know exactly what's going to happen. All we have are promises made on the campaign trail and what's being said, over the airwaves. But I think that all economists should think about, what could be some of the scenarios. We might have renewed tariffs. Those tariffs could be broad. If we do see large amounts of people being deported, or even the announcement effect, you could start seeing people leave their jobs, and that would cause shortages in some of our key industries. We don't know exactly what's going to happen, but it's certainly something that we should, look at in our risk scenarios, and potentially some of those things might become the base case.
Dana, put all of that in a dot plot. How difficult is that going to be in December?
Well, I think it's going to be very difficult because all the FOMC participants are just like the rest of us. They're hearing the same things. They know about all the different risks that there could be to the economy. There could be spending cuts in order to work out a deal for the debt ceiling, or even to pay for extended tax cuts. All those things factor into the outlook. So it's really, what do you think is most likely? And then you have to go with that in terms of your dot plot. And so I think we could see a pretty wild dot plot with numbers all over the place, given the uncertainty.
Dana, given that you focus on consumer confidence and just business confidence, how much are you actually seeing a real shift upward in terms of confidence post-election to make investments, to do certain structural changes that could increase growth versus the same constraints that were there before, which is high rates and still a lack of clarity?
Sure. We don't have any hard data. Our consumer confidence measure comes out next week. That may capture some election elements. And certainly for CEOs and executives, we do speak with them. And we're hearing a mix of things. Some are excited that there could be more deregulation, which would potentially help cut red tape for them. Certainly now that the uncertainty around the election is over, we know who won and what the composition of Congress looks like. They may start investing again. But others are concerned about if industrial policies that were passed that were helpful for reshoring and building factories and building out infrastructure are still going to be there. And again, the big word in the room is tariffs. Are we going to see higher costs for imports that most likely companies are going to pass on to the consumer? And so very mixed feelings right now. And I think it really depends upon what industry you're in and what your expectations are for next year.
Dana, looking forward to your data when it gets released. Thanks for being with us. Dana Peterson there, the conference board, following jobless claims dropping just moments ago and literally dropping to 213. Much lower than we anticipated and lower than the previous week as well. That is the right kind of downside surprise on jobless claims in America. I'm looking forward to consumer sentiment by political party, because there is, and we've seen evidence of this repeatedly, that overnight Republicans will feel much better about the US economy and overnight Democrats will feel much worse.
It's a wonderful sort of reality check of what we're talking about when we talk about consumer confidence and how fickle it can be. But I do love that. We're going to just basically see, it's going to just completely diverge.
It's why Paul Donovan of UBS, every time he gets surveys, he was like, ignore them. They're actually just political polling. Look at the real data. Look at things like retail sales if you actually want to see what he calls the hedonism of the U.S. consumer.
Are people going out and spending or not? And based on retail sales so far, retail sales have been pretty decent. Revisions were really strong. You go through the retail earnings we've had so far, remove Target out from that, Walmart, TJ Maxx, things are looking pretty decent.
And that's because of the economic data that preceded the election. And I think that's what everyone keeps coming back to. And that is what Aditya Bhave was saying, that essentially they have revised their outlook for the Federal Reserve, not just because of the election, on the margins, maybe because of potential policies, but because of the trajectory of an economy that has shown and proven itself to have much more heat in it than people expected.
A series of upside surprises. Where did you say the surprise index was now, the highest since?
Well, it's kind of teetering around the highest level since April. I don't want to say it's at the highest because it's
since
not.
Spring.
Yes, thanks.
Around those levels.
That's good.
Pretty decent. Joining us now, Kristina Campmany of Invesco. Kristina, good morning. It's good to see you.
Thanks so much for having me in.
Are we still on a one-way road back to 4% on Fed funds, or are we facing a bit of a pause here, some disruption?
I think that there's very much the case to go in December, and then the Fed has 100 basis points of easing under their belt. And I think it is prudent to pause. And we've been talking about, do we get 100, do we get 150 basis points, and then you pause? But we have clarity that we have a red sweep, but we don't have a lot more clarity than that, right? Like, what are the policy priorities? What is the magnitude? What is the order they're put into? We expect you can get one or two things done right away, and then you have some like bogged down potentially in the legislative process. But how do we prioritize them? What's the speed? What's the magnitude? And then what is the reaction function in the economy? Because as you said, the market had this dialogue in September that it was the Trump trade and that's what we were pricing. But was it that, or were we pricing the underlying resilience of the U.S. economy and the strength of the data?
A little bit of both, apparently.
Yeah.
I'm not sure how much of one versus the other, but certainly a little bit of both. Gary Cohn was with us a little bit earlier, and we talked about how accommodating or not financial markets would be of some of these policy decisions. Can we just sit on fixed income? Credit spreads are really tight. Bond yields are already quite high, based on what we've seen over the last 10 years, at least, relatively speaking. How accommodating do you think fixed income will be to any administration that wants to come in and start spending more money?
Look, so when we look at rates, and both the front end and the long end have done a lot of work to reprice higher, right? Like you've had 75 basis points of easing, and across the board, we're higher in yield levels. I think if we get this 25 basis point ease in the front end, policy is basically flat to 2 years. And I think that leaves front end securities offering a lot of value and out the credit spectrum as well, whether that's securitized products or corporates. And spread levels are tight, but I still think that there's money that's happy to park and pick up yields there at 6-7% in that spread. Out the curve, there was definitely support for the market at 4%, and I don't think people expected us to even get up and push these 450 levels. And that's kind of what we've been looking for since September, that there needed to be more steepness in the curve. And if anything, I think we've been surprised that we haven't been able to steepen. But I think the risks are still out the curve. And what are the inflationary impacts of all of these policies, of tariff, of deportations, changing the labor force dynamics, right? Like the economy, the objective has been to hold this soft landing, and now we're going to have melding. So let's see what we get from it.
Gary Cohn made a really interesting point that this administration would likely try to term out some of the U.S. debt, that the previous administration, the current administration, has been selling a lot of short-term debt, and that probably the next one will look more toward longer-dated bonds. He sees the bond market starting to sniff that out. How much of that has been priced in? What would that do to the long end of the yield curve?
Look, I think having sat in the U.S. rates market for a long time, it's something that we always talk about of like, why are we not terming out the debt? And certainly with the curve still inverted, it feels very like that there is an opportunity there to term out the debt and lock in rates. Obviously, rates are higher than they were 5 years ago and post-GFC, but still to term out the debt. I don't know that the market's sniffing it out because the curve is still inverted. We haven't really had that buy-in. Same thing throughout the last number of years post-COVID, you've had realized inflation, and the market's expectation read of inflation with break-evens has been incredibly contained because the market has credibility with the Fed.
I guess that then it leads to the question of what does an orderly steepening look like at a time that preserves your long call and a number of credit and securitized instruments while still allowing the U.S. government to term out quite a bit of debt? I mean, how much could you see a steepening without really a massive market disruption?
Yeah, look, so I think the consensus for steepening in the market is different now than it was 6 months ago when the market as a whole was looking for the Fed to cut policy through neutral, and it was much more of a front-end move. Can we still see some gradual leak higher? Yes. People talk about a Liz Truss moment. That's not our expectation. I think you still have a story of U.S. exceptionalism, and that is where money is happy to come to the U.S. and be parked here. So we don't believe in the case for a disorderly steepening of the market.
Kristina, in your notes, you talk about the markets are digesting some of the appointments and the names we're hearing out of Mar-a-Lago, particularly looking for clarity on Treasury Secretary. I myself am as well. My question is, if this drags on, is that in itself a market's negative event?
I'm not sure if it is yet, right? Inauguration is the middle of January. We still have some time. We've gotten, if anything, it felt like the first 2 weeks coming out of the election results, it was rapid fire of names of who's coming out. And I think the market is digesting what is, again, who is in offices and how do they handle Trump and kind of are the mediator between the markets and what Trump would like to accomplish, I think is part of it. But I don't think the pace is an issue at this point. I think we just all are looking for clarity because there's so much uncertainty. What are the policies? What is the magnitude? What's the order? What are we prioritizing?
Do you think it's any of the personnel that could be checks on potentially some policies the president might want to enact next year? Or do you think it is going to be the markets? We were talking about with Gary Cohn, and Jonathan has talked to us tons of times. It was the stock market, Trump 1.0. Is it the bond market in 2.0?
I think from what we know from Trump 1.0, I think he cares about what the levels on the screens are, and he will be cognizant of that. And I think market perception of unfriendly policy will be reacted to.
I saw the Bloomberg terminal in the West Wing in Trump Volume 1. I was there. I've witnessed it. Kristina, it's good to see you.
Thanks so much.
Thank you so much. Kristina Campmany of Invesco. I was getting them to type in SPX and get away from Dow Jones on the screen, but, you know, I failed based on how many tweets we've seen.
You have another 4 years.
I can try again.
Go too.
Making the S&P 500 great. Not again, just great. OK, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. House Ethics Committee Republicans voted Wednesday against releasing the results of the panel's sexual misconduct probe of Matt Gaetz. The Ethics Committee has faced more pressure to publicize its findings after President-elect Donald Trump nominated Gaetz for Attorney General. House Democrats still plan to force the issue, but need at least a few Republicans to back them. Gaetz has long denied the mounting allegations against him. The brand new Department of Government Efficiency Task Force has its first proposal. In a Wall Street Journal op-ed, Elon Musk and Vivek Ramaswamy said that they plan to require federal employees to come into the office 5 days a week, resulting in a wave of voluntary terminations that, quote, we welcome. The two also derided civil servants who make decisions yet aren't elected, calling it anti-democratic and antithetical to the founders' visions. Bitcoin is nearing $100,000, now just under $98,000. Optimism on President-elect Trump's crypto support and MicroStrategy's plans to accelerate purchases of crypto fueled gains. People familiar also said that Trump's transition team is holding discussions over a White House role. The market has gained $900 billion since Trump's election win. And that's your brief. John.
Danny, thank you. A lot of people lining up to buy the dip in Nvidia this morning. That stock is higher by 1.65% now in early trading in the immediate aftermath of earnings yesterday when that forecast dropped just below some of the biggest expectations out there. This stock dropped too by 4 to 5 percentage points, fully recovering and some so far this morning, helping to push equity futures towards session highs up by 0.4%. And the data out from America so far still pretty decent. Jobless claims exceptionally low, the right kind of downside surprise. Up next, we'll set you up for the day ahead. We'll catch up with Manus Cranny and get you some movers going into the opening bell, which is about 41 minutes away. From New York, this is Bloomberg. If you are just joining us, welcome to the programme. For those of you getting ready for the trading day ahead, we're about 37 minutes away from the opening bell, with equity futures right now positive by 0.4%. The Nasdaq up by 0.5%. The Russell, the small caps, up by almost 0.8%. Your trading diary and the calendar for the week ahead looks like this. Today, some Fed speak from Hammack, Goolsbee, Schmidt and Barr. On Friday, S&P Global PMIs and NewEdge consumer sentiment. On Tuesday, looking ahead to next week, consumer confidence, new home sales and Fed minutes on Wednesday. Durable goods, a second GDP read and another round of jobless claims because markets are closed for Thanksgiving on Thursday, and we all can't wait. Seriously, that just needs to happen really quickly.
Like now.
Let's get to the holidays, like tomorrow. Before we get there, with about 37 minutes away from the opening bell, here's Manus Cranny with some morning movers. Morning, Manus.
Jonathan, Nvidia, what else do we talk about? You had the first flesh wound yesterday, which was the knee-jerk sell. We've traveled all the way back from being down 5%. Leave it to Dan Ives at Wedbush. They're producing the Blackwell chip. It is the LeBron James of chips. The point about it is you've gone from a sell first, ask questions later, down 5%. Yes, you turn it around. The margins will be at 75% next year. Roll it over. Have a look at MicroStrategy. You've been touching on Bitcoin through the morning. It's inextricably linked to this. They're actually going to sell more convertible notes to what I told you yesterday. $2.6 billion of convertible bonds are going to be sold to do what? Buy more Bitcoin. I leave you with a quick snapshot of Snowflake. How do you collate all your data in one place? Do it efficiently. One-stop shop. You do it now at Snowflake. They're making $960, $911 million on the guidance. And of course, they've got the magic word in there. They've got Anthropic, the LLM, large language model, to help you clean the data efficiently. Jonathan, good morning.
Manus, good morning. Once again to you. We appreciate it. Thank you, sir. With your morning movers going into the opening bell, just enough time for a final word around the table. Bramo.
Well, I just want to emphasize what Gary Cohn said. We don't spend enough time on the bond market, and that ultimately...
Spend some more time, by all means.
We should spend some more time on it, because I think that really is going to be the focus, which is the reason why we care about the Treasury pick.
Well, Gary Cohn made me a little bit nervous when he was talking about, remember this time in the first iteration of Trump, it was after Thanksgiving when he got the nod to leave the lead the NEC, and then Mnuchin's announcement came out. And I'm just thinking, can we actually do this for another week? Can this drag on?
We is doing a lot of heavy lifting.
We're meaning you.
Yeah, me and the team down in Washington and the others in Mar-a-Lago. Can we actually do this as Trump looks for his, quote, perfect candidate?
I think Gary's point is a point we've made around this table before, that the election was only 2 weeks ago. And this transition team is already operating well ahead of schedule.
Yeah, and I think that people are impatient because they want to understand the tales. And I think Jason Draho's points of UBS today was really telling. That basically the base case has not changed post-election. The tail risks have. And that's the reason why people want to understand the policy, both in terms of what it will be, what the sequencing will be, and what the personalities and massaging will be around said policies.
On the personality, I'm looking forward to a Thursday night special in Mar-a-Lago a little bit later on this evening.
You're trying to help her out?
It's
trying to
gonna
expedite
happen.
it?
Anne-Marie's in charge of that. Look out for reporting from Anne-Marie and the team down in Washington, D.C. on the race to be America's next Treasury Secretary under President-elect Donald Trump. Coming up tomorrow, your lineup looks like this. Mohammed Al-Aaron of Queen's College, Cambridge, will speak to the ECB Governing Council member Mario Centino. That will be very cool. We'll catch up with Raj Agrawal of KKR and Tiffany Wilding of PIMCO. From New York, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was Bloomberg Surveillance.